Hello and great welcome. Now in this particular session on your demand, actually we are coming out with an exclusive session, to be very honest with you, wherein we are going to actually have a look over the December 24 paper. Lots of demand I was receiving actually of late to hold a separate session. Even though you must have actually noticed we have already released the entire final push, our flagship courses, both in Hindi version and mixed version. Actually those are available in the YouTube, and it is a very comprehensive sort of revision. And I hope that each one of you would admit and you will be benefited a lot in case if you would go through entire lecture and at no point of time you would feel actually as if you are simply doing the what we call revision. You will have a feel as if you have done what we call almost a regular course. But anyway, actually, why I talked about this particular point, the reason being is that we have already covered all the questions which have been asked in under December 24 paper over there, under each chapter, correct? But anyway, on your request, as I told, because you asked us to actually hold a separate session for this particular what we call paper, so we have decided to accede to your what we call demand and coming out with this particular session. So under this December 24 CFR paper, first of all, section A compulsory, as you know, it carries 15 questions, 2 mark each, 30 marks, and these 30 marks are almost like a lottery for you, correct? Anyway, so choose the correct alternative, and here first question is, if external revenue reported by the operating segment, then dash is given, and further it is written, of the entity's revenue, additional operating segment should be identified as a reportable segment. You will be able to answer it only if you have gone through what we call Ind AS 108 quite well, which deals with what we call Ind AS, which deals with operating segments. As you know, if an entity is having lots of what we call segment, then for the purpose of reporting, entity will have to select out of those segments, correct? So which will be the reporting segment? As you know, an operating segment is considered as reportable when it is able to what we call satisfy any of the criteria, that is 10% criteria with respect to what we call result, with respect to revenue, result or revenue, or what we call asset. If a particular operating segment is able to meet the threshold criteria of 10% with respect to revenue, or with respect to what we call result, or with respect to asset, then generally it is classified as reportable segment, as you know. Now, presuming that this particular entity has already selected 3 segments as the reportable segment, these segments are considered as reportable segment because they are able to meet any one of these criteria. Now, they are reportable segment. Now, another condition is that whatever reportable segments are there, their external revenue in total, must be equal to either 75% or more than 75% of the total external revenue of the entity. Are you getting my point or not? Once the entity is able to actually select the what we call reportable segment, then another condition is that the total external revenue, I'm talking about external revenue, total external revenue of the reportable segment must be equal to 75% of the total external revenue of the entity, or more than 75%. Indirectly it means if the total external revenue is less than 75%, not equal to 75%. If it is less than 75%, then standard says that in that case, entity need to identify some additional reportable segments. And because in this particular case, it is written identified as reportable segment, so it is possible only when our external revenue of the reportable segment in total is less than 75% of the what we call total external revenue. So that's why in this particular case, I need not require to tell you on which alternative you are going to take mark. Is it clear to you? Then second question is, consolidated financial statements are required to be prepared by an Ind AS compliant entity if it holds shares in the investing company. When you are required to prepare the consolidated financial statement, if you have gone through the very first session of Ind AS 103, under Ind AS 103, I always start with some basic concepts. And over there, I have explained it very deeply that if you have a subsidiary company, you means you are the investor entity, I means investor entity, you will have a subsidiary entity If you have a subsidiary entity, or you have an associate entity, or you have a joint venture, in that particular case, you are supposed to prepare the consolidated financial statement. But point is that how another company could be your subsidiary company when you have the control over the other enterprise. Correct? If you have the control over the other enterprise, quite surely you are supposed to prepare the consolidated financial statement. And so many times I've told you actually how one entity can acquire the control over the other entity. You can acquire the control over the other entity either through majority stakes of more than 50% or by way of agreement. However, at the same time, if you have an associate, how can you have an associate? If you have 20% or more than 20% or more, but up to 50% stakes in the other entity, then other entity will be your associate entity. Even in that case, you will have to prepare the consolidated financial statement. And if you have what we call a joint venture, even in that particular case, you will have to actually prepare the consolidated financial statement. So here some informations are given to us. Let's go through it quickly. Entailing 20% or more voting rights having significant influence. In fact, when you have the significant influence in the other entity, then other entity is your associate. Obviously, in this particular case, you will have to actually prepare the consolidated financial statement. Entailing joint control over the investee, called a joint venture. As I just told you, if you have a joint venture, even in that case, you are supposed to prepare the consolidated financial statement. And entailing control over the investing entity and its subsidiary company. So that means in this case, all these three are correct answers. So that is why on point number D, alternative D, you will have to mark it out. Then similarly, the next one here is, which of the following is not a feature of government accounting? Which one is not a feature of government accounting? Non-fund based accounting. In fact, government accounting is fund based. So very first one will be your answer. Is it clear to you? Because government accounting is fund based. Then which of the following is not a general principle of accounting? Let's go through it quickly. The first one is reporting of utilization of public funds. It is one of the main principles. Then expenditures are classified under sectors, major heads, minor heads, sub-heads, and details of the heads. Again, it is a feature. Then budget based, again it is a feature. However, single entry system. So it is not a feature of government accounting. So that's the reason actually you will have to take it out. Then similarly, fifth one is, at what value is non-controlling interest recorded in the books of acquirer at the time of business combination in a transaction under Ind AS 103? I told you when we discussed the concepts of what we call Ind AS 103 over there, I have already mentioned, and you know already all these things, that NCI, non-controlling interest holders, they can be valued either on PSNA approach, that is proportionate share of net assets approach, or on fair value basis approach. Is it clear to you? So that is why your answer, your alternative 3 will be the correct answer in this particular case. It is recognized either at fair value or at proportionate fair value of net identifiable asset. Correct? Then this question is from financial instrument, and under the very first session we talked about this financial asset. What are financial assets? Correct. Cash is a financial asset, and equity instruments in another entity is a financial asset, a contractual right. Is it clear to you? All these are considered. I have already told you over there, if you remember actually, I told you by definition cash and equity instruments are considered as financial asset by definition itself. And then further, if you have the contractual right to receive cash or any other financial asset, even that will be considered as financial asset. So that is why contractual right is also a financial asset. So in this case, all of the above will be your correct answer. Further, it is given, an is a contract that shows residual interest in the assets of an entity after deducting all the liability. From the asset, if we deduct all the liability, then we get actually net assets. Net asset, correct? And if I have some equity instruments of the other entity, let us say I have got 10% stakes in the other entity, indirectly it means I have got 10% share in the net assets of that particular entity. So in this case, your answer will be equity instruments. Your equity instrument actually shows your share in the net assets of the other entity. In this case, it is given report is analytical tools for displaying human resources, related facts, insights, and metrics to improve the work performance or recruiting procedures and important HR operations. So it is not a very tough one to crack actually. So human resource reporting, human resources will deal with that. Human resource report actually. But anyway, the alternative, it is given human resources. Now, question number 9 here, it's an interesting one. Just pay attention over here. Milkway Limited is conducting a research in respect of attaching self-charging batteries in vehicles. So there is an entity by the name of Milky Way, and it is conducting a research with respect to what we call self-charging batteries. And it is given it has already incurred 15 lakh last year for the research. It is also given to you. And during the year, first of all, you need to understand that during the year, that means your current year in this particular case is starting from 1/4/2023, 1/4/2023, and it is ending on 31st of 3/2024. Correct? This is your current year. This is your current year. And just prior to that, actually, question has already stated that it has already incurred 15 lakh last year for this particular research. Last year means actually last year must have actually commenced on 1/4/2022 and ended on 31st of 3/2023. Actually, we are not concerned with the last year, but anyway, it is given in the question that, and this entity has incurred 15 lakh last year on the particular research. And further, now it is stated that during 23-24, it incurs 5 lakh each. It incurs 5 lakh each month as a part of its research expenditure. Now, first of all, it is given that in the current year, entity has incurred 5 lakh rupees per month. 5 lakh rupees per month entity has incurred. It is clearly given in the question. Now, further, it is written that on 1/5/2023. Now, our accounting year will start from 1st of April. Then when we reached 1st of May, it is given that on 1st of May, 1/5/2023. Now it is written that on 1st of 5/2023, directors found that research is successful and is going to bring a cash flow of 300 in the coming years to the company. The important point which you need to understand, even though we are doing objective sort of question, but my endeavors are always to give you as much as detailed answers as possible. Correct? So on 1/5/2023, question states that director found that research is successful. If research is successful, indirectly it also means now asset recognition criteria is met. Correct? If you are doing some sort of research, and over there you have already spent some amount, and afterwards you find actually that particular asset has met spending or research has met the asset recognition criteria, because it is also clearly stated that research is successful and in future it will bring inflows of 300 to the company. Indirectly it means the asset recognition criteria is met. But very important, question has stated that in this case, in the current year, company is spending 5 lakh per month. 5 lakh per month. That means in the month of April, you must have spent 5 lakh rupees. Correct? After spending 5 lakh in the month of April, on 1st of May 2023, you found that asset recognition criteria is met. If asset recognition criteria is met, indirectly it means now you are going to recognize an intangible asset. Now, question is not asking you on this date at what value you are going to recognize the asset. Question is asking you at the end of the year, see here, as at 31st of March 2024, at what value intangible asset need to be recognized. The point is that because company is spending 5 lakh per month, that means from here on till up to this particular date, company must have spent 5 lakh into 11 months, that is equal to 55 lakhs. Because once the asset is recognized as an intangible asset, whatever expenditure we are going to incur, that will be capitalized. Indirectly, it will be considered, or it will be considered as a part of the cost of the intangible asset. So by the end of the current accounting year, we may say that we are having an intangible asset to the tune of rupees 55 lakh. So entire treatment of expenditure in the current year, actually question is asking entire treatment of your total expenditure. You are spending 5 lakh each month, so total you have spent 60 lakh in the current year. So in the very first month, whatever you spent, that will be what we call treated as part of revenue expenditure, you are going to expense it to your profit or loss account, while you are going to recognize what we call 55 lakh worth of asset. Remember one thing, this line is of no use that this asset is going to bring us what we call return of 300. Generally, such information is used for computing value in use. The question is not asking anything regarding that. Question is simply asking the treatment of the total expenditure which you have incurred in the current year. Is it clear to you? Similarly, the amount is spent last year, it must have been already debited to profit or loss account last year. Is it clear to you or not? So this is the point. In this case, your correct answer will be expense of rupees, that is your alternative 3, alternative C, expense is 5 lakh and intangible asset 55 lakh. Is it clear to you? Now another question, question number 10 is also given to you. Given by the Pua Mart, I do not know whether I spelled it correctly or not. Anyway, this entity, Pua Mart, whatever it is, has given some information with respect to average trading profit of last 4 years is equal to 7 lakh. Average trading profit of last 4 years are already given to you. Average capital employed by the firm is 45 lakh is also given, and normal rate of return is 10%. I need not require to tell you what you are supposed to do in this particular question. Your average profit of the last 4 years, average profit is given to you as 7 lakh. Your capital employed is 45 lakh and you are going to apply 10% to it. So what you are going to get? Normal profit. So your normal profit will be equal to 4,50,000. After subtracting normal profit from the average trading profit, we may say that we are getting super profit, correct? So super profit must be equal to 2,50,000. 2,50,000 will be our super profit. Is it clear to you? Now question says that present value of annuity of rupee 1 for 4 years at the rate of 10% is 3.1699. So in this case, question is asking the value of goodwill on the basis of annuity of super profits. So in order to compute what we call annuity or super profits, in order to compute the goodwill, you need to simply multiply this 2,50,000 with this what we call annuity factor of 4 years. Indirectly, it means logically, see here, if suppose I will multiply it with 4, I will also get the goodwill, but this goodwill is in absolute terms. This goodwill is in absolute terms. Question is not asking goodwill in what we call absolute terms. They are interested in finding the present value. Indirectly, it means. So that is the reason I am going to multiply it with the what we call annuity factor of 4 years. So 3.1699 I will multiply, and it will be equal to this much. I have given you the solution, complete solution also. 7,92,475 will be your value. And that is the reason actually you are going to actually find that alternative B will be your answer. Now under point number 11, it is given to you that Aura Limited leased a machine with a fair value of 1,65,000. So quite obviously you will be able to answer it only if you have gone through Ind AS 116, correct, quite well. Aura Limited actually leased a machine. That means they have taken a machine on lease. First of all, you need to understand that. Aura Limited leased a machine with a fair value of 1,65,000 for a period of 5 years under finance lease. The initial direct cost incurred in negotiating the lease was 1,250, and the present value of the minimum lease payment discounted at the rate of implicit in the lease is 1,58,400. Under the requirement of Ind AS 116 leases, the amount for which the machine will be recognized in Aura's financial statement. Actually, just kindly pay attention here and then you will be able to understand it. First of all, if we have gone through Ind AS 116, correct, I've already told you all the Ind AS, rather entire what we call course is available on YouTube. You must subscribe to the channels I have given over here, correct? You can go through if you really want to have a very deep study, but exam-oriented study at the same time, correct? Then you must actually go through all these revision sessions. But anyway, as per Ind AS 116, correct, how the right of use asset and what we call at the same time lease liability is going to be recognized. Generally, the lease liability will be recognized at present value. Now, here he has already given that present value of minimum lease payment is 1,58,500. So, lease liability is 1 lakh. Present value of minimum lease payment is equal to 1,58,400. So logically, we may say in this case that lease liability must be recognized at this particular value. But the question is not asking this. Question is asking at what value the right of use asset, the machine, will be recognized. So in order to recognize the right of use asset, that is machine in this particular case, first of all, I will write the present value of lease liability. If you remember, we did lots of questions in our regular classes and even in our review study sessions. So 1,58,400 will be my present value of lease liability. 1,58,400, it will be considered as the present value of lease liability. If you remember, I also talked about that in case if there are some initial direct cost, which in this case is, question has written here that initial direct cost incurred in negotiating the lease is 1,250. So in case if there are any initial direct cost, you will have to add it to this particular value to know at what value you are going to actually reflect the right of use asset. So by adding these two, you will get this particular value. So in this case, 1,59,650 will be the correct alternative. Is it clear to you? And then 12th, A Limited has a machine whose original cost is 1,20,000. Further, it is given that accumulated depreciation on the machine is rupees 45,000. Now you have a machine where accumulated depreciation is 45,000. So 120 minus 45 is your what we call carrying amount at this particular moment. Similar machine has recently been sold in the locality at 65,000. What you need to understand at this particular moment, if you really want to solve this particular question, at this moment, the carrying amount of your machine. What is the carrying amount of your machine if I am going to ask you? What is the carrying amount of machine? 1,20,000 cost is already given to you. And it is also stated very clearly in the question that your accumulated depreciation is 45,000. So all you have to do is to subtract the amount of depreciation. So if I am going to subtract 45,000 from 1,25,000, I think I will get 75,000 if I am not wrong. I may be wrong, no problem, but you write the correct value. Is it clear to you? Now, further, it is given that similar machine has been sold in the same locality at 65,000 with selling expenses of rupees 4,000. As you know, under what we call Ind AS 36 impairment, we have already gone through all these what we call concepts of recoverable amount. If you remember, I have told you that recoverable amount is higher of what? It is higher of higher of one net set. Generally we write it as fair value less cost of disposal, and indirectly it means net selling price less associated expenses. For example, in this case we have been given that net selling price is actually 65,000. If same sort of machinery we are going to sell out in the same locality, it may fetch us actually 65,000, but I may have to incur what we call selling expense of rupees 4,000. So 4,000 worth of expenses I will have to incur. So in that case, net selling price, also known as fair value less cost of disposal, will be mine 61,000. And then further it is given to you that management determine the entity specific present value of future cash flow of the machine is 68,000. Now this is fair value less cost of disposal, and then I am going to compare it with the value in use. Correct? Value in use. And value in use is nothing but it is the present value of the future cash flows over the remaining life which this particular machine would fetch us. However, you are clearly given in this case that present value of the future cash flow which this particular machine would give you is equal to 68,000. Now you have already seen that out of what we call these two figures, which one is higher? 68,000 is higher figure. So you are going to write here recoverable amount as 68,000. Out of these two, the higher figure is 68,000. Now you are going to compare it with what we call carrying amount. Because your carrying amount is higher, Then the recoverable amount, that means there is an impairment loss, and impairment loss will be to the extent of 7,000. We have done all this particular question here also. You can see carrying amount is 75,000, recoverable amount higher of all this thing. So that is why recoverable amount will be 68, and now you are going to take the difference. 7,000 will be your correct answer. Is it clear to you? 13th. On 1st of January 2024, A Limited acquired 80% of the equity interest of B Limited in exchange of cash of rupees 6 lakhs. Now, lots of questions we have already done, correct? Wherein you are supposed to compute the amount of goodwill under Ind AS 103. We did such question, and even what we call under what we call Ind AS 110. On 1st of January 2024, here it is written A Limited acquired 80% of the equity interest of B Limited. So first of all, you are being given that in this case, you are A Limited, correct? You are the parent entity, and you have acquired in B Limited 80% stakes, correct? And for the same, you have delivered a consideration of rupees 600 lakhs in cash. Also, it is written that identifiable assets are measured at 925 lakh and liabilities assumed are measured at 150 lakh. So it is given to you that in the beginning itself you have acquired the control. So on that particular date, that means on the date of acquisition, the net identifiable assets of B Limited will be equal to 925 minus 150 lakh. This will give you the net assets. And out of these net assets, correct? Further, it is written that fair value of 20% non-controlling interest is 90 lakh. Now, this time fair value of non-controlling interest is already given to you. So, out of these net assets, we may say that NCI's share will be equal to 90 lakh. Now, whatever remaining share will be there, that means it is the share of the parent, that is A Limited. Once you know the share of the parent, you simply actually match it with the consideration to know the amount of goodwill, and this is exactly what question has asked. Actually, question has asked the gain on bargain purchase will be. Let's see whether there is a gain on bargain purchase or goodwill. Fair value of net identifiable asset 925 minus 150, that means net assets on the date of acquisition 775 lakh. And from there on, as I told you, first of all, I need to subtract the NCI share, which happens to be 90 in this case. Remember one thing, fair value of NCI is already given. Is it clear to you? So we are left off with 685. That means this is the share of the parent in the net assets, correct? That means parent is getting 685 lakh worth of net asset, and for the same they are actually paying 600. So quite obviously in this case there is gain on bargain purchase. So gain on bargain purchase 85. So 85 is your correct answer. In question number 14, it is given to you that as per Ind AS 28, an entity with joint control of or significant influence over an investee shall account for its investment in an associate or joint venture using the. First of all, you need to understand that if you really want to dig deep, if you really want to quickly actually just do the solution, it will not help you a lot. Try to understand. Just a moment ago, I told you consolidated financial statement and entity need to prepare when we have control. If investor entity has control over the other enterprise, if we have the control over the other enterprise, and so many times I have already told you, you can get the control over the other enterprise when you have more than 50% of the stakes, or when what we call you have the agreement with the what we call shareholders of the other entity that we are going to actually compose your board of directors, or for that instance we are going to actually direct your relevant activities. So under such circumstances, it is always construed and inferred that we are having the control over the other entity. And if we have the control over the other entity, then under that we are supposed to prepare the consolidated financial statement on the date of acquisition as per Ind AS 103. On the date of acquisition, we have to prepare CFS as per Ind AS 103. However, at the year end and subsequent year end, we are supposed to prepare consolidated financial statement as per Ind AS 110. Is it clear to you or not? Besides that, if you are the investor entity and you are having what we call, let us say, more than 20% stakes in the other entity, but up to 50%, correct? Then I need not require to tell you. Indirectly, it means this time you are having what we call significant influence over the other entity. you are having significant, not control, but you are having significant influence over the other entity, and other entity will be considered as your associate entity. Even under such circumstances, investor will have to prepare the consolidated financial statement, but consolidated financial statement will have to be drawn out as per what we call Ind AS 28. As per Ind AS 28. Is it clear to you? Similarly, if you are an investor entity and let us say you have invested in a joint venture, even in that particular case, you will have to prepare the consolidated financial statement as per Ind AS 28. But the point is that when you are going to prepare the consolidated financial statement as per Ind AS 28, in that case, you will have to use equity method. Is it clear to you or not? So in this case, your correct answer will be equity method, but all these things as a professional student, you should be aware of. Then we move over to the 15th question, correct? Here it is written, Mogari Limited provides the following financial data for the year ended 31st of March 2024. So, and it's a pretty easy question. This question is from economic value added. And net operating profit before interest and tax is given to us. Remember one thing, in order to find out the value added, we require NOPAT. NOPAT means net operating profit after taxes. Net operating profit after taxes indirectly also means net operating profit before interest but after taxes. We call it NOPAT, net operating profit after taxes, but it means actually net operating profit before interest but after taxes. That means ultimately I need to first of all find out NOPAT, net operating profit after taxes. Is it clear to you? And in this question, if you have gone through quite closely and deeply, then you must have noticed actually net operating profit before interest and tax is given to you. That means now only thing you are supposed to do is to subtract the amount of tax and you will get this figure. Because this figure means actually net operating profit before interest and after tax. And we are being given here net operating profit before interest and before tax. So only thing is that I have to now subtract the amount of tax. Further, it is given total capital employed is 80 lakh and corporate tax is 30%. Corporate tax means the tax on company's income. So, and further you are also given weighted average cost of capital 20% and we are supposed to find out economic value added. In order to find out the economic value added, as I told you, first of all, net operating profit before interest and tax is already given to us. So all I have to do is now is to subtract the amount of the tax, and the amount of tax will be your 5,25,000. That means after what we call subtracting the amount of tax, immediately I will get net operating profit before interest but after tax, and it is known as NOPAT. Now all I have to do is to subtract now the cost of operating capital employed. Our capital employed is given, weighted average cost of capital is given 9,60,000, so 2,65,000 will be your what we call economic value added. So this will be your correct answer. Correct? So in this particular session, we are going to do only this particular part. As you know, I am quite busy with other things also. It is not possible to, in just what we call one straight session, I should be able to actually solve all the questions because I have to discuss each and everything. And as I already told you, our endeavors are always to give you not only just the solution, but with that, what we call sort of knowledge, so that next time if you are able to face such question, you should be in a position to actually tackle the same without any hitch. Correct? So we are, after having especially discussed section A, now we are moving over to section B. Now under section B, actually, even though you have a choice, as you know, you are supposed to attempt only 5 questions. And I'm sure none among you have gone for question number 2, because especially the first part of this particular question was a little bit tough for those who haven't gone through these concepts quite well. But anyway, I will do it for you. Mohan Limited purchased a machinery on 1/4/2029 costing rupees 4 lakh. So on 1/4/2029, the machinery was purchased and the useful life of the machine was useful life of the machine was 10 years, and company decided to charge depreciation under straight line method. Accordingly, on 1/4/2023, the carrying amount of the asset was determined as follows. Now try to understand first of all. Actually, in this particular year, as you have already seen, that machinery has been purchased on 1/4/2019. This is the day on which you have purchased the machinery. Obviously, when you are going to reach 31st of 3, 2020, your first year will come to an end. Similarly, on 31st of 3, 2021, your second year will come to an end. On 31st of 3, 2022, your third year will come to an end. And on 31st of 3, 2023, your fourth year will come to an end. Because here it is stated in the question that on 1/4/2023, the carrying amount has been determined as follows. Honestly speaking, with the information in our hand, we can also determine the carrying amount. For example, it is given to us that cost of the machinery is 4 lakh. Cost of the machinery is 4 lakh. It is given to us. And no residual value is given in the question. And it is also given that useful life of the machinery was estimated at 10 years. So when I would purchase the machine, quite obviously, I will compute my depreciation as 40,000 per annum. 40,000 per annum. That means at the end of the first year, I will charge a depreciation of 40,000. At the end of second year, I will also charge a depreciation of 40,000. Likewise, in the third year and similarly in the fourth year, I will charge depreciation of 40,000, 40,000, 40,000. That means till up to 31st of 3, 2023, this company must have charged a depreciation of 1,60,000. And that is why it is given that at the end of the third year, or you can say in the beginning of the fourth year, on 1/4/2023, the situation is as follows. And this is exactly the situation which we have got. We can say that cost of the machine is 4 lakh and total depreciation is equal to 1,60,000. So the net carrying amount must be equal to 240. And this is exactly given to us that gross carrying amount is 4 lakh and total accumulated depreciation is 1,60,000. And net carrying amount on 31st of 3, 2023 or 1/4/2023 is 2,40,000. So on 1/4/2023, this is the position of the company. Is it clear to you or not? Now further, it is given that on 1/4/2023, company performed a revaluation of its plant and machinery. Now on this particular date, company performed a revaluation. And on account of revaluation, what we found? On that date, the fair value of the machine was considered as rupees 3 lakh. Now, technically, you have already seen that on 1/4/2023, the carrying amount of your machinery is 2,40,000. And on this date, when you perform the revaluation, you found that the value of your machinery has gone up to actually 3 lakh. So, under normal circumstances, what will be the treatment? Under normal circumstances, if the value of the machinery increases, generally we pass a very simple entry. Whenever the value of the machinery increases, we simply pass an entry, property, plant and equipment account debit to assets revaluation reserve account or simply revaluation reserve account, because value has gone up from 240 to 3 lakh, because it is stated in the question that on this particular date, on 1/4/2023, the carrying amount of the machinery is 240 and the fair value was considered at 3 lakh. So that means the value of the machinery has gone up by 60,000. So under normal circumstances, generally this will be the entry. Generally this will be the entry. No doubt about that. But here, in this particular question, some twists have been added. And see here. And further, it is also stated that total useful life, however, remained unchanged. Total useful life have remained unchanged means on this particular date when we perform the test. Remember one thing, out of your original life of 10 years, 4 years have already gone by. That means 6 years are still remaining. So that means even after the performance of this particular test, we may say that still the life is same as usual as it was estimated earlier. That means 6 years are still remaining. Correct? There is no change in the useful life. Show how the company should account for revaluation and depreciation per annum subsequent to revaluation if the company decides that. Now, in this particular question, it has been asked after the revaluation, correct? How you are going to actually do the accounting treatment under two circumstances, two situations have been given to you, correct? The gross carrying amount of the asset will be adjusted in a manner that it is consistent with the revaluation of the carrying amount of the asset. Now, question is asking us that the value of the machinery on 1/4/2023 is 2,40,000 net value. Net value is 2,40,000. A revaluation has been done. Obviously, after revaluation, we found that the value is now equal to 3 lakh. And now question is asking that do the accounting treatment if company or the entity decides that the gross amount of the asset will be adjusted in a manner that is consistent, that is consistent here stands for in proportion to, that is in proportion to the revaluation of the carrying amount of the asset. What does it mean? Now, in order to solve the first part of the question, correct? In order to solve the first part of the question, how you will have to move about. See here. I've already told you the original position of the original position which is given to us, that is on 1/4/2023, you may say actually. On 1/4/2023, when company performed the revaluation test, remember one thing, 4 years have already gone by. And after 4 years, the situation is like this. The gross value of the asset is 4 lakh. It is given to us. Gross value is 4 lakh. Gross value means original cost. And total accumulated depreciation for 4 years is equal to 1,60,000. It is given to us. Correct? And net carrying amount is equal to 2,40,000. Net carrying amount is equal to 2,40,000. Of course, we had just about a moment ago seen that the value now of this net carrying amount has been estimated at rupees 3 lakh. Just allow me to actually create a bit of space for me. I think it's okay, right? So in this particular case, you have noticed that value of this particular machinery has gone up to rupees 3 lakh, or it is estimated at rupees 3 lakh. Is it clear to you? Indirectly, we may say that there is an increase of 60,000 in the net value because of revaluation. No doubt, it's a revaluation gain. No doubt about that. But this time, question has given it a twist that do the treatment in this manner that even the gross amount of the asset will be adjusted. Here, adjusted stands for increase. Is it clear to you? Because the value is going up. So you can read this sentence as follows, that the gross amount of the asset will be adjusted or increased in a manner which is in proportion to the increase in revalue. Now you will be able to get the solution. See here, if your net book value is 2,40,000 and it is increasing by 60,000, then what will be the proportionate increase in gross value? If your net value is increasing by 60,000, so if I want to have a proportionate adjustment in the gross value, I will have to adjust it, but I will have to adjust it in the same proportion. So in the same proportion, how can I adjust? See here, for 2,40,000, increase is equal to 60,000. For 2,40,000, increase is equal to 60,000, and if the value is 4 lakh, then what should be the increase? The increase will be equal to 4 lakh into 60,000. This will be the proportionate increase. 60,000 divided by 2,40,000. You can say so. So if I am going to compute, that is 60 divided by 4 lakh divided by 4 is equal to 1 lakh. So technically it means if net book value is increasing by 60,000, so as per this particular proportion, I may say that this gross value must increase by 1 lakh. This gross value must increase by 1 lakh. That means after the increment, the gross value now will be equal to 5 lakh. But question has not only talked about gross value. The gross carrying amount of the asset will be adjusted in a manner that is consistent with the revaluation of the carrying amount. Because we have done the revaluation of the carrying amount, so indirectly now I will have to actually increase the what we call accumulated depreciation, because when the value of the asset will increase, I will have to charge more depreciation. So indirectly now I will have to compute the increase in accumulated depreciation. So on same basis, I am going to compute. See here, if 2,40,000 is the net book value, if 2,40,000 is the net book value, the increment is 60,000. If accumulated depreciation is 1,60,000, then how much it should increase in the same proportion? That is 1,60,000 into 60,000 divided by 2,40,000. divided by 2,40,000. That is 60 divided by 2,40,000 is 1/4, I think 4. So 160 divided by 4 is equal to 40,000. I hope now you got the actually answer to it. So that means I will have to increase my accumulated depreciation by 40,000. Number one, I will have to increase gross value by 1 lakh. In order to increase the gross value, I will have to actually debit the property, plant and equipment. Similarly, I will have to increase the accumulated depreciation. To increase accumulated depreciation, because accumulated depreciation has a credit balance, I will have to actually credit it. Are you getting my point or not? And because there is a revaluation of 60,000, revaluation gain, I will have to credit it. So my entry will be property, plant and equipment account debit 1 lakh. To accumulated depreciation account 40,000 and to revaluation reserve 60,000. And the final position after this will be like this. Now total depreciation will be equal to 2 lakh, and as you can see, now this value will appear in the balance sheet carrying amount. So this will be the position after the what we call all this particular treatment. And at the same time, what will be my depreciation? Because now the net carrying amount is 3 lakh and remaining life is 6. So I will charge a depreciation on 3 lakh. That means depreciation for the fourth year ended, for the fifth year ended, when we will reach at the end of 31st of 3/2024, I am going to charge a depreciation of 50,000. Is it clear to you or not how you are going to? It's a tough part and no one will give you solution in such a manner. I did not require to tell you. I am the only faculty in this case. Actually, I take it very arrogantly. You can say so, and if you allow me to do so. Correct? So in this case, see here, I have written case A, carrying amount in the beginning, which is given to us after, in the beginning means in the beginning of 1/4/2023 is 2,40,000, as I told you. And because of upward revaluation, the revised carrying amount, as I told you, is equal to 3 lakh. Is it clear to you? And your revised depreciation will be equal to 50,000. Actually, how you have come over to this particular position, here is the entry. First of all, you will have to do this working, which I did here, and for the same, I have done it for you here also. See here. Net carrying amount is 2,40,000. Increase is 60,000. So what will be the increase in the value of 4 lakh? So you can compute it 1 lakh as I just computed. Similarly, if the net carrying amount is 240 and value is increasing by 60,000, by how much accumulated depreciation will increase? As I computed earlier, it will increase by what we call 40,000, and it will increase by 1 lakh as I told you earlier. So total increase in property, plant and equipment is 40. Total increase in accumulated depreciation 40, and increase in revaluation reserve is 60, and for that you will have to pass this entry. Correct? That is property, plant and equipment account debit 1 lakh, and then accumulated depreciation you will increase, and gain on revaluation or revaluation reserve account 60,000. And besides that, now you are going to charge depreciation at the end of the fourth year. That is, at 4 years have already gone by, sorry. At the end of the fifth year, you are going to pass this entry. So under case A, your solution will be your working note. This is a sort of your working note. Actually, working note number 1, you can say after doing the working note, you can pass the entry, and then you can show the revised position like this. This is your revised position. Is it clear to you or not? Is it clear to you? This is how you are going to do, and no one will give you a solution to you in this, at least in this manner. I can challenge it. Now further here it is given to you, in this particular case, second situation is also given. Here it is stated that accumulated depreciation, if the entity decides that accumulated depreciation will be eliminated against the gross carrying amount of the asset, what will be the accounting treatment? Value, your net carrying value is increasing by 60,000. And now entity is telling that we are no more interested in keeping the accumulated depreciation. The accumulated depreciation will be eliminated against the gross carrying amount. Against the gross carrying amount. In order to make you understand the position under point number 2, accumulated depreciation is eliminated against the gross carrying amount. Under it, what you are supposed to do, first of all, pay attention here. As you have already seen that your gross value is how much? Your gross value is 4 lakh at this particular moment on 1/4/2023. And total accumulated depreciation is equal to 1,60,000 on 1/4/2023. Now it is stated in the particular, of course your net carrying amount, I have already told you your net carrying amount is 2,40,000 after 4 years. and now its value has gone up by 60,000. Its value has gone up by 60,000, no doubt about that. Is it clear to you? But now the company or the entity is deciding that we want to actually eliminate the accumulated depreciation. If entity want to what we call eliminate the accumulated depreciation, that means accumulated depreciation will become zero. I will have to debit it because it has got a credit balance. I will have to debit it. Are you getting my point or not? I will have to debit it to make it zero balance. Then only I will be able to eliminate it. And when I will be able to eliminate it, what will happen? I want to eliminate it. So indirectly, it means so far this particular entity was keeping the asset on cost basis. So far, this particular entity was keeping the asset on cost basis and keeping the what we call track of depreciation in a separate account, that is on accumulated depreciation basis. Indirectly, when it is stated in the question that accumulated depreciation need to be wiped out, indirectly it means company wants to keep the asset on net carrying basis, net carrying amount basis. So when you are going to eliminate accumulated depreciation, the gross value of your asset will also fall. That doesn't mean that it will increase, because indirectly it means now you are going to charge this accumulated depreciation to the plant and machinery account, because so far you haven't charged it. So far total depreciation has been kept in a separate account, accumulated depreciation account, and now you are going to actually simply charge it off against the property, plant and equipment. So property, plant and equipment will be credited by 1,60,000. Because now you will have to eliminate the amount of accumulated depreciation. So this is the first point which you need to do. This is point number 1, wherein you will have to actually debit the accumulated depreciation. So this is the entry you will have to pass. See here, accumulated depreciation account debit, and to property, plant and equipment account 1,60,000. Now because of this particular entry, now what is happening? Now because of this particular entry, what is the position now? That means the position is that 4 lakh was the gross value earlier, and now accumulated depreciation is charged against the property, plant and machinery account. So property, plant and machinery account will fall by 1,60,000 and accumulated depreciation will become zero. Now because asset will be reflected now at 2,40,000 after this particular entry. That means after this particular entry, now situation is only like this. Our net carrying amount of the asset is 2,40,000. Now all I have to do is to pass the entry for the increase. Now if I am going to pass the entry for the increase, my entry will be property, plant and equipment account debit 60,000 to revaluation reserve or gain on revaluation account 60,000. On account of this entry, now what will happen? On account of this entry, now property, plant and equipment will increase by 60,000. So now the net carrying amount is equal to 3 lakh. So what will be the amount of depreciation? Because remaining life is 6 years. So again, the depreciation I am going to charge will be equal to 50,000. So that is why your third entry will be like this: depreciation account debit to property, plant and equipment account. This is how you are supposed to do. Actually, both the part of this particular question were pretty tough, and I'm sure none among you have gone for what we call, or might have gone for this particular question in the examination. All those similar sort of question we had covered in our regular sessions. And point number B, see here, a major depreciable asset of Padma Limited was purchased at a cost of 45 million on 1st of July 2021. A major depreciable asset of Padma Limited was purchased at a cost of rupees 45 million on 1st of July 2021. The asset has a useful life till the 31st of March 2029. Now, first of all, you let me know actually when this asset was purchased. This asset has been purchased on 1st of July 2021. Is it clear to you? If asset has been purchased, so I presume that accounting year must have started from 1/4/2021 and it will end on 31st of 3/2022, number 1. And it has been purchased on 1st of July. 1st of July 2021, the asset has been purchased. Are you getting my point or not? So that means in the current period, I may say this asset has been used for 9 months. Is it clear to you? And question has stated that this particular asset has got a life till up to 31st of March 2029. That means, obviously, my first accounting year will end over here, but in this particular year, we have used the asset for only 9 months. You should not lose sight of this particular fact. Similarly, your next year will fall on 03/2023, correct, 31st of March 2023. Your third year will come to an end on March 24, 31st March 2024. Similarly, fourth year will end on 25. Similarly, your fifth year will come to an end on this particular date. Your sixth year will come to an end over this particular date. And 31st March 2028, your seventh year will come to an end. And finally, 03/2029, because it is stated that this particular asset has got a life of what we call 31st March 2029 till up to this particular date. So all in all, there are total 8 years, no doubt about that, because we have computed first year, second year till up to 8 years. But here you need to understand that this is our completed year, this is our completed year, this is completed year, this is completed year, this is completed year, this is completed year. You will get the solution somewhere else also. Correct? Even your institute has given the what we call solution now. But the point is that we gave the solution when this question was asked. In fact, after 2 days, I gave the solution. Number one, and no one will give you solution in this manner. The point is this. Now see here, out of 8, there are 7 years are completed years. But the very first year is not a completed year as far as use of the asset is concerned. That is only 9 months. 7 years are completed. 7 years are complete year. That means 12 monthly period. But the very first year is of 9 months. So 7 years plus 9 by 12 months. I can say the life of this asset is equal to 7 complete years plus 9 by 12 years. This is the total life of this particular asset. I may say so or not. Kindly actually give me the answer. Am I right or not? 7 years completed, and the first year out of 12 months we have used the asset for 9 months. So I may say 7 plus 9 divided by 12, I think it is equal to 0.75. So this is the total life, or indirectly I may say 7.75 years is the total life of this particular asset. Is it clear to you or not? Is it clear? Total life is this much of this particular asset. The very first thing which you need to actually track out is this much. Number one. Number two, further it is stated that estimated residual value is 650 million. Now, estimated residual value is 650 million. It is also given, and originally you purchased the asset for 45,000 million. At least you are now in a position to compute the depreciation. This is exactly what I have written here. Purchase price on 1/7/2021 is 45,000 and 650 is your residual value. So the net depreciable value will be this much. And just a moment ago, I told you life of the asset is 7.75 years. So I may say depreciation on 12 monthly basis. That means for 12 months, depreciation will be equal to 75724 per year depreciation, you can call it. Is it clear to you or not? Is it clear? Fine. Move back. Now what is happening? Now question says that the selling price of the asset on 31st of March 2024. Now see, at 31st of March 2024, I think selling price of the asset on 31st March, right? On 31st March 2024, it is given. That means we have reached the end of third year, you can say. We have reached the end of the third year, and after reaching the end of the third year, it is given in the question that expected selling price is actually 25,000. It is given to you 25,000 million, and expenses which you would incur in connection with such sale will be known as actually cost of disposal. So this is your net expected selling price or cost of disposal, you may say so, 24,500. It is also known as fair value of cost of disposal. Is it clear to you? Net total expected selling price and then you are subtracting cost of disposal. You can call it net selling price, or you can call it fair value less cost of disposal. Is it clear to you? But it is given on this particular date. That is after having reached the end of the third year. Is it clear to you? Further, it is given that expected cash flow from the asset are as under. Now it is also given to you because we have reached the end of the third year. 1 year, 2 year, 3 year, 4 year, 5 years are still remaining. That means this asset has got a remaining life of 5 years, and during these remaining life, this asset is capable of fetching the return of what we call 7,500 million, 7,000, 6,500, 6,000 and 5,000. That means cash flows are also given. Now with the help of the cash flows, you will be able to find out. Remember one thing, this information is given to you on what we call at the end of 31st of 3, 2024. That means after having reached the end of the what we call third year. You are being given this information that net selling price of the asset is this much. And further, you can also find out value in use. As you know, such information is generally used for the computation of finding the value in use. In order to find the value in use, you are also being given what we call discount rate of 9%. And your discount factors are also given to you in the question. I have told you when we took what we call Ind AS 36 over there, we did lots of such question, and even over there I told you in case if you are going to get a question like this one, you will always be given discount factor, so you need not require to worry on, you need not require to actually worry on that particular count. Is it clear to you? So with the help of this, now I am in a position to compute the value in use. Okay, I will compute the value in use. I have computed value in use here. See here, value in use. In order to compute the value in use, I have taken into account the cash inflows of the 5 years, and in the 5th year, I should not forget that this asset will give me a return of 650 because residual value is also given. Residual value means after having reached the end of its life period, then the asset can be disposed of in the market for 650. So I am going to multiply it with the respective discount factors which is given to us. Is it clear to you? After discounting it, we will get these values, and then I will add all these value to get 25,710. So 25,710 will be mine what we call value in use. Is it clear to you or not? So I am in a position to compute the value in use, which we computed to the extent of 25,710. 25,710 is my value in use. Now we have computed value in use. As you know, the higher figure between these two items, fair value less cost of disposal and value in use, is also known as recoverable amount. So your recoverable amount will be 25,710. Number one. However, now it is given in the question that you are required, further it is also given that company provides depreciation on a straight line basis. You are required to determine the following on 31st of March 2024. Carrying amount of the asset. So that means first of all I need to find out the carrying amount on 31st of March 2024. Correct? And how I am going to find it out? See here. We have already discussed till up to this particular point, whereby I have already told you that depreciation per year will be equal to 5724. Now see here, we have purchased this asset. Don't forget that particular date. Correct? You have purchased this particular asset on this particular date, as I told you earlier, on 1/7/2021. That means when I am going to reach the what we call end of 31st of 3 2022, that means I will have to charge the depreciation for 9 months. So here I have written depreciation for 9 months up to 31st 3 2022. It will be equal to 4293. Is it clear to you? That because we have already computed depreciation 5724, it is for 12 months. So 5724 into 9 divided by 12, you will get 4293. Now I will get the depreciation for 31st 3 2023. Again, it will be equal to 5724. Now I will compute the depreciation for the year ended 31st 3 2024. It is 5724. That means till up to 31st 3 2024, total depreciation charged is 5724, 5724 and 4293. Now my cost of the asset is 45,000 and I will subtract the depreciation, correct? 22 end, 23 end and 24 end. So after subtracting this, I will get 29,263. This is my answer number 1, carrying amount. Is it clear to you or not? Question has asked us to compute the carrying amount. Second question is value in use of the asset. I have already computed value in use of the asset at 25,710. We have already computed it. This is value in use. Now, question is asking us to compute the impairment loss, if any. I've already told you, in order to find out impairment loss, we will have to compare the carrying amount with the recoverable amount. Now we have the carrying amount, we have the recoverable amount. So you can see here, your carrying amount, as I told you a moment ago, 29,263 is my carrying amount, isn't it or not? 29,263 is my carrying amount, and we have computed. Now, in order to find out the recoverable amount, I need to know the net selling price or fair value less cost of disposal, which I computed earlier. 25,000 is expected selling price and cost of disposal is 500, and recoverable amount is higher figure between what we call fair value less cost of disposal and value in use. Now you can see here that your fair value less cost of disposal is equal to 24,500. And value in use we computed 25,710. So we may say that higher figure is this much, and this is your recoverable amount. Now you are going to compare the recoverable amount with the carrying amount. Because carrying amount is higher, so I may say that in this case there is impairment loss to the extent of 3,553. This was the third question, correct? So now we have given answer to the third question, and finally question is asking us what is the revised carrying amount. Now revised carrying amount obviously will be 25,710, because if I am going to subtract impairment loss from the present carrying value of 29,263, obviously now I am going to get 25,710. Is it clear to you or not? So these are two question number 2 was extremely tough from the student perspective, in the sense because generally we have seen, and especially for those who haven't subscribed to our courses, to be very honest with you, because we have done at great length lots of case studies under Ind AS, and we covered such sort of questions. So generally a student who have gone through our courses might have not actually incurred or confronted that much of trouble, correct, at least in this particular question. So anyway, now we finish up it here, and then I will meet you in the next session. I have already told you, because of paucity of the time, it is not possible to solve the entire question paper in one stretch, and especially if I am not simply solving the question. You must have noticed, correct? I am simply trying to make you understand the what we call behind the scenes stories and the entire in-depth, insightful analysis I am trying to provide on my side. Anyway, how far actually I am succeeding in that will be known to me only through what we call your messages. Keep on writing us your messages. It gives us great amount of what we call zeal and enthusiasm, so that, and lots of vibrancy, to be very honest with you, so that we can come out with what we call such sort of videos. So as far as CFR December 24 paper is concerned, we have already finished till up to what we call section 1, and even under section 2 we have finished first 2 questions, and now we are picking up question number 3A. Question number 3A, it deals with what we call Ind AS 102 share-based payment, and in this particular question, as you can see, it is written over here, Z Limited, just allow me a second. Yes, Z Limited granted 100 share options to each of 100 employees conditional on their continuing service for 3 years. We have already covered this particular question under our revision series, as you must have noted actually, because under the revision series we have taken into account all the past year papers related to that particular chapter. But anyway, Z Limited granted 100 share options to each of its 100 employees conditional on their continuing in the service for 3 years, and fair value of the share option on the grant date happens to be 30. And during the first year, 36 employees left, and the entity revised its estimate of total employee departure over 3 years period from 20% to 16%. So far in this particular line, what exactly is given to you, that this particular company has entered into a sort of contract with the employees whereby entity has committed that it is going to give 100 options to each of its 100 employees. And the condition is that the employee will have to serve the organization at least for the next 3 years, and then only they will be able to become entitled to these options. Fair value of the option on the grant date happens to be 30. Correct? Now this particular line, during the first year 36 employees have left, So by the end of the first year, 36 employees have already left the organization, and then now it is written that entity revised its total estimate of departure over 3-year period from 20% to 16%. What does it mean? That means when this particular entity announced the scheme, on that particular date, first of all, let me actually just clarify this. It is given to you that Jet Limited has given 100 options, and there are total 800 employees. There are total 800 employees in the organization, and the agreement is that we shall give you 100 options. So 100 options per employee. That is the commitment. 100 options per employee. Correct? Number one. Number two, the condition is that employee will have to serve the organization for the next 3 years. Is it clear to you or not? So first year end, second year end, and third year end. And fair value on the grant date is 30. I have told you so many times, fair value of the option. What does it mean? It means whenever employee, after what we call serving the organization for the specified period of time, when they will become entitled to and when they actually exercise the option. So whatever market price will be there on that particular date, correct, we shall give you a concession of 30 per share. That is what we mean by fair value of the option. So fair value of the option is a sort of compensation, is a sort of concession, it is a sort of discount which is given by an entity. Is it clear to you? Indirectly, it means it is the difference between market price and exercise price. It is the difference between market price and exercise price. Now, this particular line I was talking about, that entity revised. And before that, it was also given that at the end of the first year, 36 employees actually left. 36 employees have actually left. It is also given to you in this particular question. And further, now it is given that entity revised its estimate of total departure over 3-year period from 20% to 16%. What does it mean? That means when entity reached the end of the year and when entity found that 36 employees have already left the organization, so entity thought actually it is better to revise our initial departure rate. So initial departure rate means when entity announced the scheme on that date, entity might be of the opinion that total 20% employees would leave the organization by the end of the vesting period, by the end of the third period, correct? So entity is of the opinion that by the end of the third period, out of 800 in total, 20%, that is 160 employees would leave the organization. But however, when entity reached the end of the year, entity found actually that 36 employees have left, so entity now revised the departure rate. So now the departure rate at the end of the first year has been revised to 16%. Has been revised to 16%, what does it mean? Indirectly, it means now company is of the opinion that out of our total 800 employees, total 16% employees would leave the organization. Now entity is of the opinion that by the end of the vesting period, vesting period is third year, correct? By the end of the vesting period, in total, out of 800, 16% employee would leave. That means entity is of the opinion that out of 800, 128 employees will leave the organization. So when entity reached the end of the year, so entity is expecting that by the end of the third year, in total 128 employees would leave. But you must not forget that out of 128, 36 employees have already left. So I may say that expected to leave will be 128 minus 36. Correct? 128 minus 36 is equal to 92. So if you will add actually 36 plus 92, it will come to 128. Indirectly, what I want to say is that entity is of the opinion when entity reached the end of the first year, that in total, by the end of the vesting period, 128 employees would leave the organization, and out of that, 36 employees have already left. So quite obviously, it leads to the conclusion that 92 more employees would leave the organization by the end of the vesting period. Now further, it is given in the question that during the second year, a further 40 employees left. So when we reach the end of the second year, 40 more employees have left. 36 have already left by the end of the first year. And when we reach the second year, we found that 40 more employees have left the organization. The entity revised its estimate of total departure over 3-year period from 16% to 13%. So now this entity again revised the departure rate to 13%. Again revise the departure rate to 13%. What does it mean? Now entity is of the opinion that out of 800, by the end of the vesting period, only 13% employees will leave the organization. Now, if I'm going to compute 13% of 800, it will be equal to how much? 104. So that means now entity thinks that by the end of the vesting period, in total 104 employees will leave the organization. Correct? But we must not forget, we are at the end of the second year at this particular moment, and entity thinks actually that by the end of the vesting period, 104 employees will leave. So what does it mean? It means that out of 104, 36 plus 40, 76 employees actually already have already left. And we are estimating that total 104 employees will leave. And in total, by the end of the second year, 76 employees have already left. So if I'm going to subtract 76 from 104, it means 28 more employees are going to leave the organization. So expected to leave will be equal to 28 when I am going to reach the end of the second year. Correct? So by the end of the second year, I may say that 28 employees are more expected to leave because 36 plus 40, 76 employees have already left. Is it clear to you or not? Now further it is given to you, during the third year, if further 28 employees left. Now when we reach the end of the third year, we found that 28 more employees have left the organization, and because we have reached the end of the what we call vesting period, this time you will not require expected to leave. Correct? And moreover, no departure rate will be given to you because we have already reached the end of the third year. So it is given only 28 more employees have left. Now it is given that all the continuing employees exercise the option to subscribe the equity shares of 10 each at rupees 50. So all those who became entitled, correct, all the continuing employees exercise the option to subscribe 50 at the rate of rupees 50 when the market price is rupees 84. When market price is rupees 84, further it is given journal entries of all the years and show the workings. Now in this particular question, if you want to solve, I have given you a very detailed what we call solution. I've already told you we have already covered all these questions of past paper under our final series. Suppose if you want to actually do December 23, December 22, December 21 question, all question you will find over there in our final revision series also. Anyway, here we go and we just have a look. More or less, I've already given you an idea. So this is the beginning. This is the analysis of the question. This is how you need to do in the examination, first year end, second year end, third year end. So in the beginning of the first year of, obviously this is the grant date, number of employees 800 and fair value is 30. And you can also note out that 100 option entity is willing to give to each of the employees. So this is the what we call original data. And departure rate, of course, on this particular date, entity was of the opinion that total 20% employees would leave the organization. But when we reach the end of the first year, as I told you, now the departure rate is 16%. And for your convenience, I have written over here that 16%, it means entity is of the opinion that in total, out of 800 into 16%, 128 employees will leave the organization by the end of the vesting period, as I told you. So entity is of the opinion when entity reaches the end of the first year that 128 employees will leave by the end of the what we call vesting period. But as I told you, at the end of the first year itself, 28 employees have already left. 36 employees have already left. So if I am going to subtract actual left 36, then I will be left off with 92. It means 92 more employees are expected to leave. So total 128 employees will leave by the end of the what we call third year. Similarly, when I will move into the second year, as I told you, now entity is of the opinion that 13% employees are going to actually leave the organization. Isn't it or not? And I computed 13% actually and it came to 104. That means at the end of the second year, now entity is of the opinion that by the end of the what we call third year, total 104 employees will leave. And as I told you, out of 104, actually 76 already have left. So because it is given in the question that 40 employees have left, so in total, by the end of the third year, by the end of the second year, 36 plus 40, total 76 employees have left. So, and we are expecting that 104 employees would leave. So it means actually 28 more employees are expected to leave. So the second year scenario is that 40 actually left and you are expecting 28 more to leave. And it is given in the question that at the end of the third year, 28 employees have left. I have already told you in the third year, you need not require to find out expected to leave. Now we can find out the recognition and calculation of employees' compensation expenses. Suppose I want to compute the what we call expenses for the first year. Obviously, I will start in this fashion. Employees in the beginning is 800, and as I told you, actually left 36, expected to leave 92. Basically, what is the idea? Idea is I want to know how many employees are going to complete the vesting period. So by subtracting, or I could have subtracted directly 128, ultimately I will find, because when I am at the end of the first year, I think actually total 128 employees will leave, 36 have left, 92 are expected to leave. So ultimately it means that 672 employees are going to complete the vesting period. And to each of those employees, I will have to offer 100 options. So 672 into 100 means total options. And each option carry a fair value of rupees 30. Correct? So that means your total, this 20,16,000, it means this is the total fair value of the option. And total fair value of the option basically means total employee compensation expenses. So that means total compensation expenses when we are at the end of the first year, we are estimating that total expenses over 3-year period will amount to 20,16,000. But we have reached the end of the first year. So how much out of that I need to recognize? Obviously, the proportion of the vesting period expired is 1. Out of 3 years, total 1, 2, 3. Out of 3 years, 1 year has already elapsed or expired. So 1 by 3 will be the proportion. That means by the end of the first year, I need to recognize 6,72,000. It is known as cumulative expenses recognized. And I have written here previously recognized because I am already at the end of the first year. No question of recognition of any expenses earlier to it. So indirectly, it means expenses to be recognized in the current year, that is 6,72,000. Similarly, now I will move over to end of year 2, wherein again I am going to write first of all 800. Now I am at the end of the second year. By the end of the second year, 36 plus 40, actually this is 36. 36 plus 40, 76 employees have already left. Is it clear to you? And as we computed, 28 employees are expected to leave. Correct? I have computed here somewhere, and moreover it was given in the table also. Correct? See, by the end of the second year, 36 plus 40, 76 employees have left and 28 more are expected to leave. So we expect now that 696 employees will ultimately complete the scheme. If 696 employees are going to complete the scheme, we will have to offer them 100 option. Correct? So total 6,96,000, sorry, total 69600, 69,600 options I may have to offer, and each option carry what we call 30 fair value. So the total expenses, when I reach the end of the second year, I find actually that total expenses shall amount to 20,88,000. That means in the first year, I estimated that total expenses of the scheme would amount to 20,16,000. But as per my second year calculation, now I think that total expenses of 3-year period would amount to 20,88,000. Now we have reached the end of the second year. So that means vesting period expired is equal to 2. So out of 3, 2 periods have already gone by. So into 2 by 3, it will tell me cumulative amount of expense which I should recognize by the end of the second year. So by the end of the second year, I need to recognize 13,92,000, isn't it or not? And out of 13,92,000, as I told you, 6,72,000 worth of expenses have already been recognized. So in the second year, I need to actually recognize 7,20,000, isn't it? Now we move over to the final year. In the final year, what I need to do? How many employees have actually left? 36, 40 and 28. No question of expected to leave. So ultimately we found actually, now the position is absolutely clear that 696 employees have completed the scheme. Correct? Now the position is absolutely clear because vesting period is over. To each of these employees, I will have to offer 100 options, and over there I will have to give them a concession of 30. So the total expenses now I find actually are coming to 20,88,000 over 3-year period of time. So by the end of third year, total expenses I need to recognize is 20,88,000. But out of 20,88,000, I have already recognized 6,72,000 and 7,20,000, total 13,92,000 expenses. So in the final year, I will have to recognize 6,96,000. Is it clear to you? Because it is a case of equity settled plan, It is a case of equity settled plan, number one. Why? The reason is that here we are offering them what we call options. Correct? No cash settlement is being made. Now, in this case, your entry, at the end of each year, you are going to pass the entry employees compensation expense account debit to share-based payment reserve equity account. Correct? At the end of the first year, as I told you, you are going to recognize this much of expense, in the second year this much, and in the third year 6,96,000. Importantly, you need to understand that it is stated in the question that employees are paying for each share. First of all, the question is telling us that 696 employees have completed the scheme. Obviously, now the entity is under an obligation to offer them 100 options, as I told you, isn't it? And it is given in the question that exercise price is 50. In the final two lines, it was given to you. Kindly pay attention. At the rate of rupees 50, all continuing employees exercise the option, correct, to subscribe the share at the rate of 50. Just to confuse you, it is also given market price is 84. So don't get confused by that. Because it is given to you that employees are actually exercising the option at the rate of 50. That means employees are paying only 50, and we have already committed to them that we are going to offer you what we call 30 as the concession. Correct? So indirectly, it means the day on which employees are actually exercising the option, on that date, market price purely must be equal to 80. So we are not concerned with 84. Is it clear to you? So point is that if you want to write the entry, in this particular case, you can write it in this manner. Bank account debit. Now, employees are 696 employees in 200. Because you will have to offer 69,600 options, 696 employees in 200, and each employee will pay you 50, so 34,80,000. Then you will write your share-based payment reserve equity account, you can write in bracket, correct, 696 into 100 into 30, it will come to 20,88,000. Now this was your liability, now you are debiting it because now employees are exercising the option, so your obligation to issue share-based payment reserve equity will get wiped out. That is why you will have to debit the same. Is it clear to you? Now you will have to write to equity share capital. Ultimately, you are issuing them equity share capital. And it is given in the question that face value of the share is 10. So 6,96,000 will be the face value. That means total value is 80. And face value is 10, that means 70 will be the premium. So in this particular case, you will have to write two security premium, 696 into 100 into 70, 48,72,000. This is how you will have to do this particular question. Is it clear to you? The next one is from internal reconstruction, I think, or Goodwill. I think it is from Goodwill. Even this particular question we have covered under valuation of shares. Sorry, valuation of shares or valuation of Goodwill, I think so. Whatever it is. Let me check up whether this question is from Goodwill or... Right. This question combined, this is combined question of valuation of Goodwill and shares. So under revision series, you can watch this valuation of Goodwill and shares. I have already told you our revision series is already available. Correct? Under the title, Final Push 3.0, Final Push 3.30. We have covered each and every chapter very comprehensively. Over there, you can get what we call questions and their solid, standard, authentic answers, at least of last 4 or 5 attempt papers. Is it clear to you? So let's have a look over here. Following is the balance sheet of Rukmani Limited as on 31st of March 2024, and non-current assets are given to you. Under the non-current asset, we are being provided property, plant and equipment, 24 lakh. Then we have financial asset, investment in 10% securities, that is our investment, 4,80,000. And then under the current asset, we are being given inventory worth rupees 10 lakh, and besides that, we are being given trade receivable to the extent of 15 lakh, then cash at bank, that is equal to 4,20,000. This is the total of the asset side. Coming over to the equity, we are being provided under the share capital, under the equity share capital of rupees 10 each. Here it is written 20 lakh. What is this 2 lakh? Okay, I will check it later on. Then under the other equity, we are being given 15 lakh. And then we are being given 10% debentures. 10% debentures is equal to 15 lakh. I think this line is wrongly printed. Equity share capital 20 lakh. So 20 plus 30, that makes it 50, 58, it's okay. So this is unnecessarily printed. I'm very sure that this won't be over there in your notes. Anyway, so other equity is 15 lakh, and then we are being given 10% debenture and then trade payables to the extent of 8 lakh. Total is 58 lakh. Further in the question, now it is given to you additional information. Nominal value of investment is 5 lakh. Your investment, which is written in the outer column, is actually 4 lakh 80,000. This 4 lakh 80,000, what does it suggest? First of all, what we mean by investment. Investment obviously means you have invested your amount in some securities. This 4 lakh 80 suggests the amount paid by you. Now the question says that the nominal value of these securities is equal to 5 lakh, although we are not concerned with that. Is it clear to you? Number one. Number two, here it is written, following assets are revalued. Property, plant and equipment has gone up to 36 lakh, inventory 11 lakh, and trade payable receivable is equal to 13 lakh 50,000. Further in the question, it is also given that average profit before tax of the company is 12 lakh and rate of taxation is 30%. Now the question states that goodwill may be valued at 3 years purchase of average trading profit after tax. Correct? This is one question, that goodwill may be valued at 3 years purchase of average trading profit, and further it is given ascertain the value of each equity share under intrinsic value. So you have to find the value of the goodwill in this particular question. I told you even in my revisionary sessions that in the examination generally you tend to get a combined question wherein you will be asked to compute the amount of goodwill and valuation of shares you will have to do. First of all, my basic target is obviously first to compute the what we call goodwill, and in order to compute the goodwill, I need to have the what we call super profits. Correct? Goodwill is to be valued at 3 years purchase of average trading profits after tax. It is also given in the question. So, first of all, here I have written property, plant and equipment is 36 lakh. Because we are computing net assets or capital employed at this particular moment in the context of the goodwill. And I have told you several times, and especially I have done a thorough what we call discussions. So those among you who want to clarify this particular point of capital employed, especially in the context of what we call goodwill and in the context of valuation of share, kindly actually go through that particular session and the final posture is with respect to valuation of goodwill and shares. Anyway, because investment, I have already told you, if nothing is mentioned, whether the investment are trading or non-trading, always presume it as non-trading. And if investment is non-trading, that means it is not a trading asset, because in the context of goodwill, we are trying to find out operating capital employed. So when we take into account operating capital employed, we never take into account non-operating assets, correct? And investment is non-trading investment, and it is a non-operating asset because the funds are being utilized by others. Is it clear to you? Now, inventories are given to us, and revised value we will consider obviously, and revised value of property, plant and equipment we have considered. Similarly, trade receivable and cash we will consider. Is it clear? So total is equal to 64 lakh 70,000. Now I'm going to subtract the liabilities, creditors, debentures. After subtracting the same, now I will get the capital employed. You can also call it net assets. Correct? There is also what we call it is also known as net assets or capital employed. So in the context of goodwill, we may say that our operating capital employed is 41 lakh 70,000. Now I will take into account the average profit. It is given to you already in the question that average profits of the company, average profit before tax are rupees 12 lakh and rate of tax happens to be 30%. Average trading profits are given. Average trading profits are given to you, that is 12 lakh. Now, important point is that, problem is that when you must have computed your profit, whatever interest which you must have earned in your investment, through your investment, you must have had credited it to your profit and loss account. So that is the reason I will have to subtract the interest on investment. Now, interest on investment, kindly pay attention. Interest on investment is always, interest or for that instance dividend, is always computed on the nominal value. The nominal value of your investment is given in the question 5 lakh. And so 5 lakh of 10%, 10% is the rate of investment. So 50,000 you will subtract. So now we may say that my true profits are 11 lakh 50,000 because I will have to subtract the non-trading incomes. Now I will apply the taxation rate. So tax at the rate of I think 30% will be equal to 3,45,000. So we can now find that this is our what we call average profit, 8,05,000. And it is given in the question that goodwill is to be based, because these are average profits, correct? Goodwill is to be computed at 3 years purchase of average profit. So I will have to simply multiply it with 3 to get the amount of goodwill, which happens to be 24,15,000. Once I have determined the amount of goodwill, now I will take into account the what we call valuation of the share. And for the purpose of valuing the share, we need to have the net assets. But the point is that in case of goodwill, in the context of goodwill, when we compute the net assets, we never take into account, as I told you, goodwill. We never take into account non-trading investment. We never take into account non-operating assets. I have given you in my regular classes the meaning of what we call non-operating asset, like work in progress, like assets under construction, like any piece of land or what we call any asset which is held by an entity for the purpose of sales. So all these non-operating assets, in fact goodwill, because in the context of goodwill I am talking about, when we compute capital employed, we never take into account goodwill, non-trading investment, and all such assets, correct, which are not being used in the what we call business. But when we do valuation of share, in that case, for the calculation of the net asset, we take into account all types of assets. Is it clear to you or not? Is it clear to you? Now we already have, because basic purpose or idea here is that because we have to compute the intrinsic value of the shares. And in order to compute the intrinsic value of the share, I need to have the net assets. Net assets is nothing but capital employed. So net assets, I directly write here 41,70,000. This is the what we call capital employed, which we computed for the computation of the goodwill. So what I am going to do, now I will add back here investment, number one, and I will have to take into account the goodwill also now. So now we can say that net assets available for shareholder is equal to 70,65,000. In this question, there is no preference share capital. If there would have been any preference share capital, as you know, we have to subtract the same. So now we may say net assets available for equity shareholder is equal to 35,01,000. Now all I need to do is to simply divide it by the number of equity share to get what we call intrinsic value of share. So this is how we are going to compute intrinsic value of share in this particular case. Is it clear to you or not? Fourth A, this is the almost same question number 4 of our study material. While closing the books of account on 31st of March 2027, a non-banking company has its advances classified as follows. So this question is related to NBFC. NBFC. In my regular classes and in my final push series, I have given what we call, I've done lots of discussion with respect to NBFCs. I've already told you, you need to focus upon 3 topics, especially if net owned funds, correct? This is one topic. Then provisioning, second topic. And especially provisioning aspect, many people do not know, differ with respect to what we call loans and advances and with respect to what we call lease rentals. But anyway, so in this particular question, in order to make you understand, first of all, I would like to tell you that all the NBFCs at this particular moment, we can divide them into deposit taking and non-deposit taking. Deposit taking and non-deposit taking. If you remember, isn't it or not? There are some deposit taking while there are some non-deposit taking. At the same time, non-deposit taking NBFCs can be further segregated into systemically important and not systemically important. That means non-deposit taking company could be non-deposit taking systemically important, or it could be not systemically important. Is it clear to you? Is it clear? Now, in this question, we are simply asked that while closing its books of account on 31st of March 2027, a non-banking company has the following situation with respect to its loans and advances. And you are supposed to compute the what we call amount of provision. So it is stated that calculate the amount of provision which must be made against the advances. In order to solve this particular question, all you need to do is to just, you must be knowing the what we call true rate of provisions. That's all. So you can easily handle this particular question. But If you remember in our what we call final push series and even in our regular sessions, we have talked about this particular fact. Generally, when such questions are asked in the examination, you will never ever be given whether it is a deposit taking company or it is a non-deposit taking company. So under such circumstances, see here how I have solved this particular question. Standard solution. Presumption. First, I have written the presumption that this NBFC is either a deposit taking NBFC or it is a non-deposit taking NBFC but systemically important, because provisioning rules for deposit taking NBFC and non-deposit taking systemically important are absolutely same. So you need to take that presumption. Is it clear to you? Now you will have to solve this particular question. So we are being given a standard asset 16,800. You know the rate of provision is 0.40. So your total provision will be 16,800 into 0.40 divided by 100. That is 67.20. Likewise, substandard asset are 1780 and provision rate is 10%, because we always need to presume that substandard assets are secured one. So 178. And coming over to the what we call doubtful debts. Regarding doubtful debts, such doubtful debts which are secured, time element comes into play. For example, in this particular case, it is written that these are doubtful debts and time period is given to you up to 1 year. So up to 1 year, if time period is there, then you will have to apply 20%. Correct? Then in between 1 to 3 years, you will have to apply 30%. And if it is more than 3 years, I need not require to tell you here, you apply 50%. And then if there are doubtful debts which are unsecured, in that particular case, you need not require to go for the time element. Simply 100% provision will be required. Further in this question, there are given some loss assets. With respect to loss assets, obviously the provision will be equal to this much. So total provision is this much. However, suppose if this question would have asked you in this manner, compute the amount of provision, presuming it as an NBFC which is non-deposit taking and not systemically important. Suppose if question had forced you in this manner to solve. Suppose if in this particular question, it would have been written that compute the amount of provision on the presumption that this NBFC is non-deposit taking one and not systemically important. Then the only change would have been, in case of a standard asset where I have applied 0.40, you would have applied 0.25%. Of course, these are percentages. Is it clear to you or not? All these provision are in percentage. Is it clear? This will be the only difference. Rest of the rates of the provision will remain same. Is it clear to you? So everything as a professional student you need to know actually. Anyway, as far as 4th B, this is question number 4th B, right? 4th B. Coming over to the 4th B, it is given to you that summarized balance sheet of NR Limited as on 31st of March 2024 is given to you, and balance sheet reflects that there are land and building to the extent of 15,36,000, plant and machinery 14,40,000. The goodwill is also there in this particular question, and besides that we have here goodwill 896 and inventory is equal to 2,56,000, trade receivable are 5,12,000, and then cash at bank is 38,400. Also you are being given that equity shares are of ₹5 each. Correct? So this time the face value of the equity share is of ₹5 each, 19,20,000, and besides that we have 1,28,000, 6% preference shares of ₹10 each, 12,80,000. And then we are being given general reserve. General reserve amount actually is 6,400. And then in this particular case, we are being given profit and loss account, retained earnings, debit balance. This is your debit balance. Is it clear to you? And then we are being given debentures. Debenture is equal to 7,68,000. And finally, we have trade payables to the extent of 12,80,000. It's a simple question. Internal reconstruction. Correct? We are covering CFR December 24 paper. If you want to do all the questions of the past paper, simply go to our final push series where we have covered almost every question of past year paper. Anyway, so in this particular question, it is written on revaluation of assets on 31st of March 2024. It was found that goodwill was worthless and other assets were overvalued to the extent. Because in this particular question, it is given to you very clearly that goodwill is worthless. Goodwill is worthless, so obviously you will have to write off goodwill. I have already told you that a particular entity adopts the scheme of internal reconstruction when it goes through a phase of financial crisis. Correct? And the position of the company is weak. It gets reflected when there are some overvalued items in the balance sheet. Correct? For example, in this case, we may say that goodwill is overvalued because ultimately now it is found that it is worthless. Actually, goodwill value is 0, but still we are mentioning it in the balance sheet at 8,96,000. So quite obviously it is overvalued. So the position of a company is extremely weak, extremely feeble. Correct? So it is reflected by the presence of items like overvalued items. And there may be what we call some items like as we call them valueless assets. For example, valueless assets are like preliminary expense, like underwriting commission, like discount on shares and debentures. Is it clear to you? Any suspense account, any miscellaneous expenditure account, all these are valueless asset. Is it clear to you? And besides, accumulated losses. For example, in this case, there is a debit balance in profit and loss account, as you can see. So the presence of overvalued items, valueless items, and accumulated losses, it is sort of what we call, you can say, stain on the clean image of the company. And we cannot allow such item to exist for a prolonged period of time. Otherwise, the consequences will be very disastrous. And that is why we need to write them off as early as possible. And the scheme generally adopted to do so is known as scheme of internal reconstruction. So under this scheme of internal reconstruction, basic idea is somehow to actually wipe out all these items. And so in order to wipe out all these items, I've already told you in my regular sessions actually very deeply, correct, that generally we make a request to our contributories like equity shareholder, preference shareholder. Even if the need arises, we make the request to creditors, etc., to waive a part of their contribution, to waive or remit a part of their contribution. So whatever amount they waive or remit, that amount is transferred to an account known as reconstruction account or simply capital reduction account. Now, whatever amount gets accumulated in this particular account, then we utilize the same for writing off, as I told you, overvalued items, valueless items, and what we call accumulated losses. This was the theme of this particular chapter, and quickly I try to actually recap the same. So in this particular question, now it is stated that land and building. Further, it was written that it was found that goodwill was worthless and other assets were found overvalued to the extent. First of all, it is written goodwill is 0. And now question states that other items are overvalued by 2,56,000. So that means you will have to write off building by 2,56,000. You will have to write off machinery by 3,52,000 because they are overvalued. In order to bring them to their true value, we will have to actually write what we call reduce them by 352 and 256 respectively, and goodwill full amount. Further, it is also written that a provision of 32,000 is necessary against the debtors. Correct? Now, further it is given that following a scheme of reorganization was sanctioned by the court, and as per the scheme, trade payables to accept 6% of debenture to the extent of 50% of their claims, and balance to be paid in 6 months after the date of the implementation of the scheme. Indirectly, what does it mean? Whatever trade payables are there, whatever amount of trade payables are there, they are going to accept 6% debenture for the 50% of their claim. Correct? And balance 50% will still appear in the balance sheet. Why? Because you are supposed to make the payment for the balance 6 months later after the implementation date of the scheme. So right now we are not going to make them any payment. So our entry will be like this. In this particular case, here I have written Trade payables account debit 12 lakh 80 as per balance sheet. Now see here, 26% debenture, 50%. Against 50% of their claims, we are offering them what we call 6,40,000 worth of debenture. And I have written 2 trade payable due. That means 6,40,000. We are not supposed to prepare the balance sheet. However, in case if I were to prepare the what we call balance sheet, I would have had written over there 6,40,000. Is it clear to you? This is the entry you are going to pass. Why I have written this entry at third number, I will also let you know. Further, it is given that trade payable, the paid up value of preference share is reduced to rupees 5 each. The paid up value of preference share capital will reduce to 5 each. As you know that paid up value of preference share capital is 10. So we have to reduce them by rupees 5. So in this case, I will write here 6% preference share capital. 1,28,000 preference shares are there of rupees 10 each. First of all, I am going to debit my existing preference share capital account, and new preference share capital account will be 1,28,000 into 5, 6,40,000. And indirectly this time, it is a gain. Indirectly, it also means preference shareholders are waiving or remitting 6,40,000, and I will transfer this amount to reconstruction account, or alternatively, you can write capital reduction account. Is it clear to you? Further, in this particular question, it was given that paid up value of equity share to be reduced to rupees 1 each. Reduced to 1 each. Presently, the equity share is of rupees 5 and it is being reduced to rupee 1. That means it is reducing by 4. So 4 per share is your gain. So it is always better to start with equity share capital reduction. 3,84,000 equity shares of 5 each are there. So my existing equity share capital will get wiped out because I have debited it. And instead, it will be replaced by this equity share capital, 3,84,000 into 1, because now the face value, paid up value of the equity share capital is of rupee 1 only. And I have given you reasons actually why equity shareholder will be willing to accept such an injustice. Anyway, but in my regular sessions and in my final push sessions also. So your gain will be reconstruction account debit 3,84,000 into 4, 15,36,000. The basic idea is, first of all, you need to collect all the gains. And once you are sure that you have collected all the gains, then you try to find out what is the balance, what is the net balance in your what we call reconstruction account. So in your reconstruction account, what is the balance? All you have to do is simply try to find out where you have credited the reconstruction here, 15,36,000 and 6,40,000. So we may say that total 21,76,000 is my balance. So 21,76,000, this is nothing but 15,36,000 plus 6,40,000. So it comes to 21,76,000. Now, as per the direction of the question, it was written that goodwill is worthless. So I will have to write goodwill completely. That means the present value of the goodwill is 0, so I will have to reduce it by 8,96,000. And it was stated in the question that plant and machinery is overvalued by 3,52,000. I will have to reduce it by 352,000. Likewise, land and building 2,56,000. Then further, it was again a direction in the question that we have to actually create a provision. And I told you that first of all, you will have to go by the direction. And accumulated losses and valueless item will have to be written off under the scheme of internal reconstruction, irrespective of any information or not in the question. So, profit or loss, that is retained earning debit balance, is 5,76,000 and your capital reserve is 64,400. Now, some of you may get here unnecessarily confused. Actually, in the suggested answer, this answer actually is 64,400. Plus, they have added the general reserve amount. The general reserve in the balance sheet, I think, was 6,400, right? 6,400. Correct? And in the suggested, they have given an answer something like 800 or 70,800, something like this. Correct? Because they have passed an entry, existing general reserve account debit to reconstruction account. We never write this entry. This entry is required only if there is a shortfall. So this way of presenting the solution by the institute, I am not going to agree with that. So your correct extended answer will be 64,400. However, it is not going to have any effect. Don't worry about that, because ultimately in the balance sheet, you will have the reserve amount equal to same amount. Because as per the institute, it is 70,400, and if we are going to add general reserve 6,400 and capital reserve, it will be equal to same. It is not going to have any effect. But point is that although it is a scheme of internal reconstruction, you cannot utilize existing reserve unnecessarily towards the reconstruction. It can be done only under one circumstances when the total amount available under capital reduction or reconstruction is less than the total required amount to write off. Correct? In that case, you can utilize the existing general reserve. Anyway, now you are in a position to prepare the balance sheet. Correct? And which you can do so very easily. 15 lakh 36 minus 2 lakh 56, 12 lakh 80,000. Similarly, plant and machinery, you reduced it by this much. And inventories, I think there was no change in inventory. And trade receivable, you reduced it by 32,000, so 4 lakh 80. And cash at bank 38,400. This will be your total. Balance sheet you can easily prepare. Now your equity share capital is 3,84,000 into 1. Similarly, your preference share capital 1,28,000 into 5. General reserve will come in the balance sheet, and capital reserve, which we got 64,000, will also find place over here. And your 5% debenture, because 5% debentures were already there in the question, and you have issued to trade payable 6% debenture, so now 6% debenture will also come in the balance sheet. And trade payable, as I told you, the remaining trade payable will still find place in the balance sheet because you are supposed to make the payment to them only 6 months later. So till up to that particular point of time, trade payables will stay as what we call liability in the balance sheet. Now there is another question number 5, and this is absolutely same question. Correct? Under Ind AS 103, correct? We have covered this particular question in our regular session, final session, and most of you will find that only the names are changed. Even the figures are also what we call same. It is a case of reverse acquisition. Here in this case, LS and MS Limited were amalgamated to form a new company, LMS Limited, on 31st of 3/2023, who issued requisite number of equity shares of rupees 10 each to take over the business of LS. Actually, here it is LS and MS Limited. Correct? In your notes, it will be LS and MS Limited. So, in this case, actually, what is happening, as you can see, there are two companies. One is LS Limited, another one is MS Limited. Correct? And it is given that both these companies are combining together and merging into a new entity by the name of LMS Limited. Although it is given in the question in this manner that these two companies are now, with the mutual consensus, of course, are merging into a one single unit. But I have already told you in my revisionary session, in my regular sessions, that whenever such information is furnished, you have to interpret it in this manner, that it is a new company and this company is taking over the business of these existing company. Are you getting my point or not? You will have to interpret it this way around to solve the question. That means presently we may say both these companies are acquiring company. At this moment, from the legal perspective, we may say that both these companies, LS and MS, are acquiring company, and these companies are being taken over by LMS Limited, and LMS is acquirer company. At least from the legal perspective. From the legal perspective. Is it clear to you? Now, information is also given to you regarding what we call their position. Here it is given that property, plant and equipment is 15,000 and 16,000. Financial asset, they have written 1,600 and 1,000. Figures are in lakhs. Then current asset, 9,400 and 13,000 are also given to you. Coming over to equity, we are being given share capital, that is equity share capital, 12,000. If the face value of the share is not given, always presume it as share of rupees 10 each, correct? However, this is the total share capital, 12,000 lakhs, and this is 20,000 lakhs. And then other equity is also given, 6,000 lakhs and 2,000 lakhs. Then under the non-current liability, we have borrowings, 4,000 and 6,000, and current liability, that is 4,000 and 2,000. This is the information given to us. Further, it is given that what we call their fair values. These are the fair values, the fair value of the following items, correct? So fair values are also given to you. The first company is LS Limited. Now its property, plant and equipment in the balance sheet, as you can see, is 15,000, but its revised value is given to us as 16,000. Similarly, current asset are 9,400, and even its revised value is given to us, or fair value is given to us, you can say. Similarly, of the other company, fair value is given. Fair value of property, plant and equipment is 12,000, and current asset is also given to you. In this question, the important point is given to you is fair value of the business, 15,000 and 30,000. Many a time I have seen students do not know exactly the meaning of the fair value of the business. What we mean by fair value of the business? Fair value of the business is nothing but fair value of business is nothing but what I want to write. Fair value of your total share capital. Fair value of total share capital. Fair value of business is nothing but your total fair value of share capital. For example, fair value of business of the first company LS Limited is 15,000 and MS Limited is 30,000. MS Limited is 30,000. So in this particular case, you can see actually this is the fair value and that is what we call 30,000. So I just told you fair value is nothing, fair value of business is nothing but total fair value of the share capital. Now suppose if I am going to divide it by the number of shares. This is your LS Limited, this is your MS Limited. Now we have already seen as far as number of share is concerned, I just told you the face value is never ever is not given with respect to share capital, always presume as 10. So we can say that this company is having 1,200 equity shares and this company is having 2,000 shares. So if I am going to divide it by the number of share, which comes to actually 1,200 and here it comes to 2,000. So I think now we can get the fair value per share. Fair value per share. That means we are in a position to find out the fair value per share. In this case, I think it will be equal to 12.50 and it will be equal to 15.0. Let me check it also. 15,000 divided by 1,200. That is 12.5, right? So in this case, you can see that fair value per share you have extracted, although it is not needed, but just to make the point a little bit more clear. Is it clear to you? Now in this particular question, actually what you are given, however, the control of LMS Limited is taken over by the management of MS Limited. Here I told you earlier, from the legal perspective, both these companies are acquiring company and this company happens to be the what we call acquirer company. But now the question states that, and it has clearly given that MS Limited actually for the purpose of accounting, MS Limited will be considered as the accounting acquirer. So if legal acquiry becomes the what we call accounting acquirer, then it becomes a case of reverse acquisition. So that means now you will have to presume that MS Limited is the acquirer company. Now MS Limited will have to do the accounting in its books. Is it clear to you? Indirectly, now you will have to presume that MS Limited is taking over LS Limited because the other company is LS Limited. Is it clear to you or not? So it is very simple. But only thing is that you need to know how much consideration now MS Limited will discharge LS Limited. Actually, in my regular session, we have discussed it at great length. But here, just to make the point clear. First of all, it was given in the question that control is in the hands of MS Limited. Actually, I can prove it this way, although this step is not required. Neither the first step is required, neither first step, neither second. This is just for your understanding, actually. Is it clear to you? There is LS, there is MS Limited, and combinedly, it becomes a group. I just told you fair value of the business is given. Fair value of the business 15,000, 30,000. That means the total fair value is actually 45,000. Now, you can see that total fair value of the group is 45,000 and out of that, this company's share is 1/3, 15 divided by 45 and this company's share is 2/3. So, you can see that in the group, majority of the stakes are of MS Limited. So, that is why MS Limited will be considered as the legal acquirer. Anyway, in this particular question, it was clearly given. You can directly start with what your solutions from this particular step. So under the first step, as I told you, first of all, you need to find out the fair value per share of both the companies. Correct? I have already told you how we have found, say 12.50 and 15. Now, once you have determined the fair value per share of each company, now under the next step, you will have to find out the amount of consideration which will be payable by MS Limited to LS Limited. Now this is MS Limited. Now MS Limited is the legal acquirer. Quite obviously, it will be presumed now it is taking over LS Limited. Now MS Limited will have to pay the consideration. How much consideration MS Limited will have to pay to LS Limited? See, in practical life, when we pay consideration, consideration is always paid to the owners. To the owners. And who are the owners? Shareholders. So, in order to know what is the amount of purchase consideration, first of all, we will take into account the number of shares of LS Limited. Now, number of shares of LS Limited, as I told you, is equal to 1,200. Although the face value is 10, but now they are the owners. They will demand some consideration and they will tell that market value or fair value of our share is 12.50. That is why we computed the fair value per share earlier. Is it clear to you? So they will tell, kindly give us this much of amount because our share is commanding a market value or fair value of 12.50. So 1,200 into 12.50, this will become the amount of consideration. This is exactly what I have written here. Consideration payable by MS Limited to LS Limited is 15,000. So once you have determined the amount of consideration, another important point is that now you have determined 15,000 is the amount of consideration. Now, in order to discharge this consideration, because you are the acquirer entity now, MS Limited, so how many shares you will have to discharge them? So in order to know how many shares you are going to discharge them, you will have to divide it by what we call your own fair value. In order to discharge 15,000 worth of what we call consideration, how many shares you are supposed to issue? For that, you will have to divide it by your own fair value. When you will divide it by your own fair value, you will come to know that we are supposed to issue 1,000 shares of rupees 10 each, but at the rate of 15. Is it clear to you? Only these two questions are of paramount nature. What will be the amount of consideration which the accounting acquirer will have to pay to the what we call other company? And how many shares we will have to actually issue in order to discharge the consideration. When both these things become clear, now you are in a position to handle the accounting in the books of accounting acquirer. In the books of accounting acquirer, quite obviously, you will take over all the assets. But if their revised of value or fair values are given, obviously you are going to take them. For instance, you are taking over now LS Limited. Now the fair value of property, plant and equipment of LS Limited is 16,000. Financial asset, no fair value is given, so you will presume that balance sheet value is equal to fair value. Current assets fair value is given. Then you will take over their borrowings or non-current liability and current liability. Now in this particular question, and then you will have to write here to purchase consideration. I haven't written the amount of purchase consideration. To purchase consideration or consideration payable. Consideration payable is 15,000. Now when you will compare all these items, there will be a difference over here and it will be referred to as gain on bargain purchase. Is it clear to you? Now you will have to actually discharge the consideration. As I told you, in order to discharge the consideration, you will have to offer 1,000 share. Because you are the company which is issuing the share, you will have to present the nominal value here 10,000. Then you will, besides that, you are going to write security premium 1,000 into 5,000. So these are the entries which you are supposed to actually carve out in the books of the accounting acquirer. Now you will have to prepare the balance sheet. When you will prepare the balance sheet, the only rule is that which you need to remember. While preparing consolidated balance sheet, carrying amounts of acquirer company are considered carrying amount, not the revised amount. That means when I am going to prepare the consolidated balance sheet, as far as legal acquirer is concerned, I am not going to actually take into account their fair values which are given. Only the carrying amount which is given in the balance sheet. And obviously, however, the revised and fair value of acquiring company will be considered. No doubt about that. For example, when I am going to prepare the balance sheet, first of all, I am going to write 16,000. This is property, plant and equipment at carrying amount of legal acquirer. And I have taken over the property, plant and equipment of LS Limited at 16,000. So total amount 32,000. Then financial asset. Our financial asset are 1,000, our means acquirer, and we have taken over their financial asset at a value of 1,600, 2,600. And then I will write here current asset. Our current assets are 13,000. I have written the carrying amount, but their current asset we have taken over at fair value, correct, 10,000. So I will write here 23,000. So 57,600 will be total. Coming over to the equity share capital. In the consolidated balance sheet, as you know, only the acquirer's equity share capital will find place. But the point is that acquired share capital as per balance sheet is 20,000. and you have just passed an entry to discharge the consideration account debit to equity share capital to security premium, because you have issued some shares. So that is why acquirer share capital will increase, and total share capital at nominal value of the acquirer is 30,000. Correct? And other equity, as you know, when we prepare consolidated balance sheet, only the other equity of the acquirer comes into play. So other equity of the acquirer happens to be 2,000, but it will increase because of security premium, because you issued the share at a premium. And besides that, in this particular question, as per entry number 1, there were gain on bargain purchase to the extent of 4,600. So all in all, now your equity will be equal to 11,600, and non-current liabilities, your own non-current liability is 6,000. You have taken over their current liability at 4,000, and similarly you will write what we call current liability. So this is how you are going to solve this particular question. And now only one question is remaining, which require a little bit of discussion on my side. Otherwise, this question again is similar to the one which is given in our what we call notes. Correct? This is a chain holding question, and only I need to require to tell you, you will have the full-fledged answer from our side. Correct? So now we are going to start this particular question, and this is pretty tough one, no doubt about that. Question number 6 is talking about summarized balance sheet of group companies of P Limited, Q Limited and R Limited on 31st of March 2024 is given to you. Now this is a case of what we call chain holding. I need to require to tell you. And in this particular question, what is given, let's have a look over here. First of all, you can see property, plant and equipment is given to you. And then here all the what we call respective property, plant, when later on when you are going to prepare the consolidated balance sheet, all you have to do is simply add all these items. Now further here in this particular question, as you can see, it is also given that total amount in investment. Total amount in investment is 1190, and it is written 112 lakh shares in Q Limited. Now, in this particular case, the first thing which you need to note down is that P Limited has acquired, I'm moving slowly in this particular question, P Limited has acquired 112 lakh shares. 112 lakh shares. Let's have a look actually the total number of shares. Now, total number of shares, for that, first of all, you need to have a look into the column of Q Limited. And the total share capital of the Q Limited is 1,400 lakh, and one share is of rupees 10 each. So that means total number of shares of Q Limited is equal to 140. Now let me compute the actually in this particular case the percentage. Let me compute. The percentage will be equal to 112 divided by 140 into 100. That comes to 80%. That means now I can say that P Limited has acquired 80% control of Q Limited. Is it clear to you or not? So quite obviously, we may also say that Q Limited is under the direct control of P Limited to the extent of 80%. Is it clear to you? Once we have the control over the other entity, obviously now we are one group, P and Q Limited. Q Limited is in our control. Is it clear to you? In this particular question, further it is given, now have a look into the column of what we call Q Limited. 84 lakh shares in R Limited. Now this is the investment of the Q Limited. 980 suggests the amount which is paid by Q Limited to acquire 84 lakh share. So first of all, let me actually compute. Q Limited has acquired 84 lakh shares of R Limited. So first of all, let me actually have a look over the total number of shares of R Limited. Now you can see actually that total share capital of R Limited happens to be 1120, isn't it or not? And if I'm going to divide it by 10, so I can say that total number of shares of R Limited is equal to 112. So I will have to simply compute the amount of percentage. If I am going to compute the amount of percentage, that will be equal to 84 divided by 112 into 100. That will give me 75%. It takes. So now we have reached the conclusion in this particular question. Now what is happening is that first of all, P Limited has acquired 80% control in Q Limited, number one. And as you can see, Q Limited has also invested in R Limited. and Q Limited has 75% stakes of R Limited. Correct? R Limited is subsidiary company of Q Limited and Q Limited is subsidiary company of P Limited. So that is why it is a sort of chain. This is the parent entity. Parent Limited has got what we call subsidiary company, Q Limited, and its subsidiary company has got another subsidiary company. So that is why it is a chain holding. In case of chain holding, even in my regular sessions, in my revisionary sessions, I told you actually that you have to visualize the chain holding not this way around, that P Limited is having a Q Limited as the subsidiary and Q Limited is also having a subsidiary. You need not require to view it or interpret it this way around. You have to interpret it in this manner. This is the parent entity and Parent Limited has got direct control over Q Limited. So this Q Limited from the perspective of the P Limited will be considered as an immediate subsidiary company. Q Limited is our immediate subsidiary company because we are having directly what we call control over this particular, this is directly under our control. And also in this case, I may say that P Limited has got R Limited also as its subsidiary company. Parent is controlling Q Limited and Q Limited is controlling R Limited because P Limited has got control over Q Limited. So whatever we want to get the done from R Limited, we can simply actually dictate the terms to Q Limited and get the things done from R Limited. So indirectly, Q Limited is under our direct control and R Limited is under indirect control. Indirect control. And from the perspective of Parent Limited, we may say that Q Limited is immediate subsidiary company and this is ultimate subsidiary company. This is immediate subsidiary company and this is ultimate subsidiary company. Is it clear to you or not? And of course, it is indirectly controlled. Indirectly controlled. This is the first thing which you need to know. Correct? Especially if you want to solve the chain holding questions, the way it should be actually solved. Number one. Number two, another important point is that in this particular question, because now Parent Limited will have to prepare the consolidated balance sheet and both these companies are its subsidiary now, that in this time we have the consolidation of immediate subsidiary and ultimate subsidiary. Correct? So we will have to prepare the gross financial statement whereby we need to consolidate these three companies. In order to consolidate the same, you know that Parent Limited is controlling Q Limited and over there we have got 80% stakes without any doubt. But if I want to know mathematically, because what I know is that Parent Limited is indirectly controlling R Limited, but I want to know my what we call mathematical control over R Limited. How will I control it? You can see actually that Q Limited has 75% stakes in R Limited. Q Limited has 75% stakes in R Limited. That means out of total stakes of R Limited, Q Limited is having 75% stakes. And in Q Limited, we have 80% stakes. So mathematically, I may say that I am controlling 60% of R Limited. Is it clear to you or not? So first of all, you need to know your direct stakes in your immediate subsidiary, which is 80%. You also need to know your indirect stakes in the what we call ultimate subsidiary company, which is 60%. Is it clear to you or not? Another important point in this particular question is, as you can see in this particular question, one is Q Limited, another one is R Limited. Both these are subsidiary companies from the perspective of Parent Limited. From the perspective of Parent Limited. As we have already seen that in Q Limited, parent is having 80% stakes, number one. So NCI must be having what we call 20% stakes as far as Q Limited is concerned. And in R Limited, I just told you, we have indirect control and which is mathematically equal to 60%. So I will call it 60% control is in the hands of P Limited. So in this case, I may say that 40% is NCI. This is the first thing which you need to draw out very carefully. Another important point which will help you later on is, it is given in this particular question that Q Limited has paid near about 980 lakhs. 980 lakhs they have paid to acquire the stakes in R Limited. They have paid 980 lakhs to acquire 75% stakes in R Limited. It is given in the question. But what you need to understand in this particular case is that Q Limited is under your direct control. And Q Limited cannot make this decision of its own. This decision of investing in R Limited must be a decision of the group. Must be a decision of the group. Indirectly, it means this investment has been done by the group, and the group is P and Q Limited, because Q Limited is already under our control. So first of all, you need to infer it and analyze it in this manner, that this particular investment which Q Limited has made in R Limited, correct, it is not an individual decision. You have to be very careful regarding that. What I want to say further, don't think actually that this 980 lakhs have been actually spent by what we call Q Limited all alone. Actually, this 980 lakh in worth of investment, now I may say, has been done by the group. And because in Q Limited, P Limited, parent limited is having 80% control and NCI is having 20% control. So 80% of 980, suppose I am going to compute 980 into 80%, it will tell me that 784 lakh worth of investment must have been done by P Limited. And out of 980 into 20%, that is 196. 196 worth of investment must have been done by the NCI. That means whatever investment which Q Limited has done in R Limited, you have now bifurcated it into two parts. One, this is share of investment of parent, correct, in the R Limited, and 196 is the share of investment by Q Limited in R Limited of NCI. Is it clear to you? This is very, very vital step. Is it clear to you? Both these steps are very vital to comprehend the what we call solution of this particular question. This time your module has also given pretty good answer, no doubt about that. Correct, they haven't given simply your net answer. This time they have given detailed answer, but the answer which we are going to provide you will help you in grasping the what we call intricacies. Now let's have a look. Besides that, we are being given inventories. See, when I am going to prepare later on consolidated balance sheet, I will simply add all these three items, and if there will be any unrealized profit, I will subtract it. Similarly, as far as financial asset trade receivables are concerned, trade receivables are 910, 350 and 770. I will simply add them. And in case if there are any what we call intercompany debts, I will simply subtract the same. Now in this question, there are some intercompany bills given to you. Intercompany bills, correct? For example, in the column of R Limited, it is written that 105 worth of bills are there. Then in the column of P Limited, it is written 252. Indirectly, what does it mean? Indirectly, it means actually that P Limited is supposed to receive 252 lakh worth of bills from Q Limited. Now, I will make it a little bit more simplified. First of all, lots of space actually is needed in this case. Okay, I will do it. Where should I do it? I will do it here. In this particular case, you are being given in the column of P Limited, in the column of P, Q and R. You can say in the column of what we call P Limited, it is written that 252. What does it means? Actually, all these are bills receivable. It means actually P Limited has some bills, and out of those bills, 252 worth of bills are due from what we call Q Limited. This is what we mean by it. However, at the same time, nothing is written in the column of Q Limited. That means there are no such bills, receivable in the column of what we call, in the column of Q Limited, which they are supposed to receive. However, in the column of R Limited and corresponding to P Limited, it is written 105. It is written in the column of R Limited. In the column of R Limited, there are 105 lakhs worth of bills which they are supposed to receive from P Limited. This is what we mean by that. Which they are supposed to receive from P Limited, because it is written in front of P Limited. This is written in the column of what we call P Limited, and this is written corresponding to Q Limited. It means there are bills receivable of P Limited and they are supposed to receive these bills from Q Limited. Is it clear to you so far? What will be the treatment? I will let you know. Then we are being given cash at bank. Simply we will have to total them up and we will have to put them in the consolidated balance sheet later on. Then coming over to equity and liability side in this particular question, we are being given share capital. One share is of rupees 10 each. In the consolidated balance sheet, I need not require to tell you, only 2,100 worth of share capital will find place. Correct share capital of subsidiary, immediate subsidiary and ultimate subsidiary will not come. Similarly, as far as reserves are concerned, in the consolidated balance sheet, I will write reserves 630 and 560 worth of retained earnings. Of course, I will have to make some adjustment in it. And these, what we call reserves, these reserves and retained earnings of the subsidiary companies definitely will not find place in the consolidated balance sheet because they will be used and exhausted when we are going to do the analysis table. In this question, then trade payables are given. Simply I am going to add them and put the consolidated amount. And now similarly, we are being given intercompany bills. Actually, in this question, you are being given intercompany bills, and intercompany bills payable and bills receivable both are given to you. For example, earlier regarding bills receivable, I told you. Regarding bills receivable, I told you there are some bills in the hands of P Limited worth rupees 252, I think it was 252, right? 252, which they are supposed to receive from Q Limited. In the column of Q Limited, there are no such bills which they are supposed to receive from anybody. However, in the column of R Limited, there are bills worth rupees 105 which they are supposed to receive from P Limited. This is what I exactly told you earlier. They are supposed to receive from P Limited. Now coming over to the bills payable side. In the bills payable side, what you find over here, first I write the column of P. In the column of P, there are no bills payable. In the column of P, there are no bills payable, correct? In the column of Q, there are bills payable to the extent of 252, and it is written corresponding to P Limited. That means these are bills payable of Q Limited and they are supposed to pay it to P Limited. So this is 252. Now you need to understand it carefully, correct? And similarly, as far as R Limited is concerned, there are no such bills. However, in the column of P Limited, now I find actually there are 105 lakhs worth of bills, and it is written in front of R Limited. That means this amount is payable by P Limited to R Limited. Is it clear to you? So this is the position of bills receivable and bills payable. Now try to understand this. Then you will be able to get the answer. I told you there are some bills which are held by P Limited and they are supposed to receive it from Q Limited. Correct? And here it is written in the books of Q Limited, there are 252 worth of bills which they are supposed to pay to P Limited. So it will become intercompany transaction and the net effect will be, actually this is 245. Extremely sorry, this is 245. Here it is 245 written. So as far as P Limited and Q Limited is concerned, see here, when I am going to write later on under the asset side bills receivable, I will write 252 worth of bills under the asset side when I will write bills receivable. And intercompany bills are 245. So ultimately in the outer column, I will write 7 only. Correct? In these 7s, I will write only 7. On the liability side, when I will write bills payable, as far as this 245 is concerned, these are intercompany transaction because the lower figure will be considered intercompany transaction and nothing will come over here. Similarly, now under bills receivable, once again, because even here 105 is written, this 105 are bills receivable of R Limited. And R Limited is supposed to receive these bills from P Limited, and exactly same amount is written over here under bills payable in P Limited. That means P Limited is supposed to pay 105 lakhs to R Limited. So ultimately 105 will become 0, and even under bills payable 105 will become 0. So all in all, you can see finally only net amount of 7 will appear in the balance sheet under the asset side. Is it clear to you as far as bills is concerned? Is it clear to you or not? So anyway, I'm trying my level best, and now we move over to the next part of the game. Other part is I've already explained that P Limited holds 80% shares in Q Limited. Actually, it is given in the question, but you could have computed it that way around. And Q Limited holds 75%, and their holdings were acquired on 30th of September. So 30th of September happens to be your date of acquisition. The business activities are not seasonal, and therefore it is presumed that profits have been earned evenly, and this presumption we always carry when we do consolidation. On 1st of April 2023, the books of Q and R Limited. Now these lines are very important, because ultimately in order to prepare the analysis table, we need to take care of what we call items of retained earnings and reserves of the respective subsidiary company. These are the closing balances, and we are being given opening balances. Correct? So in the beginning of the year on 1st of April 2023, it is stated that reserves of Q Limited are this much, retained earnings are this much, and likewise information is given with respect to reserves and retained earnings of R Limited. Also here it is given in this particular question, rupees 35 lakhs included in the inventory figure of Q Limited, and this is the inventory which they have purchased from R Limited at cost plus 35 lakh. Now in this question you will have to compute the unrealized profit also. In order to compute the unrealized profit, this is the case of intercompany transaction, you need not require to go for what we call in this particular case downstream upstream transaction. In case of chain holding, you directly find out the unrealized profit. The remaining stock which is included in the inventory of Q Limited is 35 lakh, and rate of profit is cost plus 25%. So on selling price it will be 25 by 125. So your unrealized profit on 35 lakhs will be equal to 7 lakh, 1/5. Is it clear to you? This 7 lakh I need not require to tell you, you will subtract it from inventory, and also this 7 lakh will be subtracted from consolidated retained earnings. Is it clear to you? Further it is given that, just wait. It is also given in this question, parent company has adopted an accounting policy to measure non-controlling interest or fair value. So in this particular question, you have to measure non-controlling interest at fair value. This is another important point. Is it clear to you? Now, in order to solve this particular question, first of all, as I always do in my regular classes and our even revisionary session, first we always mark out the opening date and the closing date. Opening date is 1/4/2023, closing date is this one, and this is your date of acquisition. Correct? 6 months obviously will be your pre-acquisition, and 6 months will be your post-acquisition period in this particular case. Degree of control, I have already told you, this should be your second step. Q Limited 80% held by P, 20% held by NCI. R Limited indirectly we are having 60%, and 40% will be considered as held by NCI. Correct? And I have given you here the explanation how I derived actually 60%, which I have already explained. Now, this is the flagship step when we solve what we call our consolidated questions. First of all, I will have to do the analysis of other equity item of subsidiary company Q Limited, immediate subsidiary company Q Limited. First I am doing the analysis, but problem is that this time each subsidiary company is having reserves and retained earnings also. So I have made 2 columns, reserves and retained earnings, and simultaneously I am going to do the working. This is with respect to Q Limited only. You have to first of all note down the closing balance of the reserves, then opening balance you can get it from additional information. By taking the difference, you will come to know that how much subsidiary company must have transferred during the year, 70 lakh. And pre and post acquisition period are 35 and 35. You segregate it, that's all. Similarly, retained earning closing balance of Q Limited is 175 and opening balance is 70. Difference will tell you the total profits earned by subsidiary company in the current accounting period, divided into 6 months pre and post acquisition period. Is it clear to you? Similarly, you can do the analysis of other equity items of subsidiary company R Limited. Correct? So simply what we call note down the closing balances of reserves and retained earnings, subtract therefrom opening balances, get how much they have transferred in the current year to general reserve and how much they have earned in the current year with respect to profit, then divide it into pre-acquisition and post-acquisition. Is it clear to you or not? Correct? So after this, now we will prepare the analysis table with respect to Q Limited. I already told you why we prepare the analysis table. In the basic idea to prepare the analysis table is to find out the amount of net assets on the date of acquisition. In order to find out net assets, we have to find out the equity, because equity always means net assets. And here I have written equity on the date of acquisition. And this is the Q Limited. First of all, we will take into account the share capital on the date of acquisition. Obviously, it will be 1,400 lakhs. Now, what about other equity? Reserves. In the beginning, the reserves were 280 as far as Q Limited is concerned. And in the first 6 months, that is pre-acquisition reserves of Q Limited are 35. That means on the date of acquisition, balance in reserve must be equal to 315. Similarly, we come over to retained earnings. The opening balance of Q Limited in the retained earning is 70. And in the first 6 months, we have earned a retained earning of 52.50. So on the date of acquisition, we must be having a retained earning of 122.50. So I may say that our net assets or equity on the date of acquisition as far as Q Limited is concerned is equal to 1837.50. Now in this question, you have to be careful. You have to compute the NCI at fair value. You have to compute the NCI at fair value. So don't immediately take 80% step. Whenever NCI need to be computed at fair value, always first of all find the NCI at fair value. But how to find the NCI at fair value? This you can find out very easily. Somewhere I might have written it. I might have not written it. Okay, I will show it for you. No problem. So we are trying to find out the NCI, correct? We are trying to find out NCI of Q Limited. First of all, I need to know what is the amount of investment in Q Limited. Whenever you need to draw out NCI at fair value, you try to find out the amount of investment in what we call Q Limited. Now, amount of investment in Q Limited is actually P Limited has invested 1190. I think this is correct, right? 1190. 1190. Just wait. Analysis of Q Limited, right? So the total investment in Q Limited, we can say, is equal to 1190. And in order to get 80% stakes in Q Limited, P Limited has invested 1190. Correct? P Limited, in order to acquire 80% stakes, have churned out 1190 lakhs. Indirectly, it means for 80%, the fair value is 1190. So we can easily now find out what we call 20% fair value of 20%. So fair value of 20% must be equal to 20 into 1190 divided by 80%. Divided by 80%. So let me compute it whether it is coming to 280 or not. 20 into 1190 divided by 80. So it is 297.50. So it is is it 1190? Let me check it up once again because we haven't taken the completed figures. Right, it is equal to 1190. I have written here 1190. 1190. So we have approximated to 280 lakhs. Is it clear to you? So in this case, 280 lakhs we have approximated. You can do the approximation if you want to. If you do not want, then you can write what we call 297.50. Is it clear to you? Actually, it is 297.50. So normally we are supposed to determine NCI in this manner, and this is normally the what we call procedure which we adopt to find out the value of what we call NCI in case if the question asks to actually compute the value of NCI at fair value, isn't it? Most of the time actually we have to adopt what we call this approach to find out the value. But in this particular question, there is a last line and it is of paramount importance. Let's go through the point number 5 once again. The parent company has adopted an accounting policy to measure non-controlling interest at fair value or quoted market price, applying Ind AS 103, assuming that market price of the shares of Q Limited and R Limited are same as their respective face value. Now the point here is that in this particular case, it is clearly given that the market price and what we call face value is absolutely same. Market price and face value is absolutely same. So in this particular case, if I want to determine what we call NCI at fair value, all I need to do is simply compute the total face value of the share capital. Now total face value of the share capital of Q Limited. Let's see what is the what we call share capital given. Now share capital, if I will look into the balance sheet, where is the balance sheet? This is just wait. Reserves, right? This is the what we call total share capital. Total share capital is 1,400, and question says that because this time the face value and market price is same, so that means the total fair value of the share capital, total fair value of the share capital of Q Limited is this much and total fair value of R Limited is this much. So in this case, instead of going for this methodology of computing the what we call NCI, we can directly compute it, correct? So this time you need not require to go for this approach because this is the usual approach we follow, correct? Because in this particular question, it is clearly stated that fair value and market value, fair value or market value is equal to the face value. So this time what I will do in order to find out the NCI, I will simply write here total fair value of share capital of Q Limited. Total fair value of share capital of Q Limited will be equal to 1,400 as it is given in the question. And now we can, total value means 100% stakes. So 100% stakes are having a fair value of 1,400. So therefore 20% stakes, NCI is 20, it will be equal to 400 and it will be equal to 280. Is it clear to you or not? So in this case, now we can say that the NCI at fair value is 280. Now I am going to subtract what we call value of NCI from the total net assets. I can easily get what we call parent share of 1557.50. Correct? Then coming over to the post-acquisition other equity, in this particular case, you find that reserves, as far as post-acquisition reserves are 35, 80% will be share of parent, 20% will be share of NCI. Likewise, post-acquisition retained earning, 80% share will be of parent and 20% share will be of NCI. Similarly, we will move into the other part, that is analysis table of R Limited. So what is the equity on the date of acquisition of R Limited? For that, we need to have share capital of R Limited on the date of acquisition. We'll find share capital obviously will be equal to 1120. Then as far as other equity items are concerned, the reserves of R Limited in the beginning were 210 and pre-acquisition reserve were 35. So on the date of acquisition, balance in reserve must be equal to 245. Retained earning of R Limited in the beginning is 105, and in the first 6 months they have earned a retained earning of 52.50. So on the date of acquisition, their total balance in retained earning must be equal to 157.50, isn't it? So we may say total net asset is equal to 1552.50. Now similarly here I have to find out the value of the NCI. So for that, first of all, I need to know what the total fair value of share capital, total fair value of share capital of R Limited. Total fair value of share capital of R Limited was 1140 as we saw earlier. Is it clear to you? So this time I will have to 1140 or 1120 it was. Let me check it up. Total fair value is 1120, not 1140. So it is 1120. So 1120 is the total fair value. You can directly take 40%. Remember one thing, in R Limited, NCI is 40%. So I will compute the 40% of 1120. 1120 into 40% gives me 448. So you can see 448 will be what we call NCI. So this time the fair value of the NCI will be considered as 448. Now you subtract what we call 448 from 1522.50. You will get the balance of the net asset as what we call share of parent in the net assets of R Limited. Then post-acquisition other equity reserves. Post-acquisition reserves are 35. This time 60% share is 21 and 40% share is 14. Retained earning post-acquisition is 52.50. 60% share will be this much, and of course then 40% share will be this much. Now we are in a position to find out the amount of goodwill. When we compute the amount of goodwill, basically what we need to compare, we compare the consideration transferred by parent limited and then share of what we call net assets. For example, here I have written net identifiable asset or fair value on the date of acquisition, that is equity share capital plus other equity. That means total net assets of Q Limited is equal to this much. We have already computed NCI. I could have directly started from this point, but anyway, so this is what we call share of parent. This is share of parent 1557.50, correct, in the net assets of Q Limited. Now we will compare it with the what we call amount of consideration transferred. Now P Limited has transferred a consideration of 1190 to get the stakes in Q Limited, and amount of consideration transferred is less than share of net assets. That is why this will be your gain on bargain purchase. Is it clear to you? Similarly, in R Limited, we found that total net assets were this much, and our share of NCI was 448. Then 1074.50, actually 159. Here I have written actually total net assets. Total net asset is equal to 1522.50. 1522.50 as far as R Limited is concerned, and NCI share is 448, so our share will be equal to 1074. Correct? This is the share of parent in the net assets of R Limited. And this is the most tricky point which you need to take care of. When I started off the session, I told you whatever investment which have been made in R Limited, correct, we bifurcated those investment, correct, into respective shares of parent and respective shares of NCI. So importantly, see here what I have written, consideration transferred. It means consideration transferred by parent. So consideration transferred by parent in R Limited actually is 784. Is it clear to you? This is the point which I discussed in the very opening stages. See here where I discussed. Here I was discussing this particular point, that total investment made by Q Limited in R Limited is 980. I told you don't consider it's an individual decision of Q Limited. Actually, this decision is of the group. So we bifurcated it into two parts, and 784 was the respective share of parent and 196 was the share of NCI. So it will help us later on, as I told you. So here it must help you that consideration transferred by parent will be considered as 784. Correct? Here I have written also total consideration transferred in R Limited is 980, but proportion of investment made by parent will be 80% of 980, that is 784. So in this case, you can see actually once again share of net assets is higher than the consideration transferred. So again it is a case of gain on bargain purchase, and total gain on bargain purchase will be equal to 658. Similarly, now you can compute the amount of NCI on reporting date. NCI on the date of acquisition we have already computed as per respective analysis table, correct? So 280 and 448 of Q Limited and R Limited. Then we will simply add the what we call share in post acquisition other equity, correct? Share in post acquisition other equity you will add, you will get what we call this figure. Actually, as far as R Limited will be concerned, NCI on reporting date will be this much, but in case of Q Limited, you must not forget to subtract the share of the NCI in the investment made in R Limited. Just a moment ago, I told you total investment made in R Limited is 980, but it's the group's decision. Out of that, 20% investment must have been made by what we call NCI. So that is why I will subtract this 196 from total NCI. So now I will get 101.50. So total NCI, which I am going to reflect later on in the balance sheet, will be equal to 581.70. Now you can see actually that unrealized profit. I've already told you unrealized profit is 7. So now we are in a position to prepare the consolidated balance sheet. I've already told you that property, plant and equipment, simply you will have to do the line by line addition. There is no revaluation. Inventory, you will have to add all the 3 items, and 7 is the unrealized profit. Trade receivable, simply add it. And regarding bills receivable, I have explained very deeply over there why only 7 will come. Is it clear to you? Similarly, cash at bank line by line addition is needed. Coming over to the equity share capital, only parent share capital will find place. Under the other equity, I will write general reserve. This is the general reserve of parent entity, and parent entity's respective share in the post-acquisition general reserves of the respective companies you are going to add to get the consolidated general reserve. Similarly, you will write consolidated retained earnings. First write the retained earnings of the parent, then add to it post-acquisition share in retained earnings of Q Limited and 29.4 in R Limited. Correct? So it is coming to actually 631.40. In Q Limited, my respective share is, let me check, in respective share of Q Limited. Where is Q Limited? Actually, I have a doubt. In Q Limited, this is, and in R Limited, respective share is actually 34.30. Correct? This is respective share is actually 21 in reserves, and in retained earnings is 34.30. Let me check it off how much I have added. In consolidated retained earnings, 42 is from Q Limited and I have added 39.40. Actually, you can directly add the total share which I have mentioned and then subtract the unrealized profit. Is it clear to you? Whatever respective share is there, for example 34 point something was the share, you simply add this 34.30 and then subtract what we call unrealized profit. So I have here directly what we call done the treatment. Is it clear to you? So 631 point this, and then gain on bargain purchase you should not forget to write. Is it clear to you or not? And then coming over to what we call NCI of Q Limited and NCI of R Limited, I have written separately, but you can combine, total them up, and you can put it up over there. Then trade payable, simply add. And I told you already, as far as bills payable is concerned, correct, only 105 minus 105, nothing will come in the outer column. So total will be equal to this much. Is it clear to you or not? So this is how you will have to do this particular question. Interesting one. And similarly, this question again is straight out of our book of question number 3. Same question. This is with respect to what we call your value added statement. And in this case, you are being given sales, correct, 1000 lakhs. And then you are being given total of all materials, work in progress and finished goods. Your closing stock is 90 and opening stock is 60. So your closing stock is higher than opening stock. So changes in inventory you are going to add to sales revenue, correct? And then you are being also given raw material purchased. You will take it as an expense, correct? Similarly, printing and stationery, auditor's fee, rent and other expenses, wages and salaries, depreciation, interest, and here you are being given wages and salary. Wages and salary, obviously, it is an item which is moving over to what we call employees of the company. And similarly, depreciation will be considered as retained by the entity. Interest is considered as a payment to the providers of the finance. And taxes will be considered as payment towards the government. And similarly, dividend will be considered as payment for the providers of the funds or owners, you can say. Retained earnings. See, retained earnings for the year is given to us as 165. This will be kept by the entity. So this is how you are going to prepare the statement. First, you write the sales revenue, add to it changes in stock. When you will add changes in stock, you must first write the closing stock, then subtract opening stock. So this will give you what we call total revenue. From there on, we subtract the cost of bought in material, correct, and services. So I told you raw material purchased, you will subtract printing and stationery, you will subtract auditor's fee, then rent, rates and other expenses. I told you when we prepare what we call value added statement, any item which is related to what we call these parties, employees, government, providers of funds and entity, will not be subtracted. So total value added will be 450. And now we call it distribution of value added or value added applied or application of value added. So here we have to show that how much value is moving towards employee or moving towards government. So in this case, we may say whatever wages and salaries are there, it is going towards employees. Similarly, taxes towards government, interest and dividend towards providers of finance. And similarly, depreciation, it is a non-cash item. When we write non-cash item on the debit side of profit and loss account, indirectly it means this much of profit is kept by the entity with itself, correct? So 30 will be added and retained profit will be added, total 195, and total will be equal to 450. Then we have some theoretical questions here. Correct. Write short note on role of controller. Rest of the questions you can easily manage. So all entire paper I have solved. This is your theoretical question again. And this question is very simple one. Correct. This is what we call business combination achieved in stages. I have solved it and you can manage this question easily. I am very sure about that. So there is nothing more, because so many times I have done this particular question in our regular sessions, in our what we call this revisionary sessions, in our final push series. So this question we have done lots of time. Again, it was straight out of our books, 3.1 of our books. We have written the marks. So you can see the entire question paper. But anyway, I do not want to take the credit of that. But the point is that if you will go through our revisionary session, you will wonder actually if we are taking the revisionary session in such a manner, then what about our regular sessions? So I would love you to, those among you who haven't actually gone through those sessions, kindly go through it. Correct? And we can assure you that after going through even our revisionary session, that is final push series 3.0, correct? Definitely you will feel lots of confidence, and I can assure you that at no point of time you would feel that you have simply done the what we call revision. You will always feel that you have done much more than the regular session. This I can assure you. So I hope actually that I have solved this particular paper, and it must have given you lots of what we call insights to how to solve the questions and how to go about it. Correct? So this is the complete, comprehensive and most standardized solutions which have been provided to you. So shall meet you in the next session with something new, obviously. Correct? And till then, it's time to say goodbye.